Testing, testing. Okay, there we go. Looked like my audio wasn't working there for a minute, and it sure wasn't. So I had to start the audio card. All right. Looks like we're live now. Some technical difficulties trying to get started here. Uh, I got started almost a half hour later than I kind of originally planned, but welcome everybody who ends up joining us either now, soon, or on the replay later. Been a couple weeks since we went live. Definitely excited to share a bunch of the stuff I've been working on with you guys. Right here in front of us, obviously, here's my portfolio. Not too much to update with, a little bit. I have made a few changes here and there. I think when we had last been together, I had already taken a position in Lennar, so that part isn't new, but I am starting to add to it. I've been doing a lot more work on housing, which we're going to discuss a decent bit of here today. Uh, I'm really kind of finalizing up all the finer details of the model for Lennar, and I'm hoping to put together a video for it at some point here in the near future. We'll see. Definitely a lot of things I want to put into that, so I'm trying to figure out exactly what all is going to go into it and what all is not going to go into it, or how long it's going to be and stuff like that. So we'll see. We'll see what comes up with that. But the plan is to make a video for it. I am pretty confident in the valuation for it. There's definitely a lot of questions and risks involved with that, but I think the valuation is just attractive regardless of of those risks. So, like I said, we'll discuss some of the more of the housing stuff here today. I know when we were on our last live, we went through this larger document uh, spreadsheet package of housing data on a larger national scale. We went through all the different regions according to the census regions in the United States, all the different housing data related to that. And I've kind of gone another layer deeper here, which is kind of the stuff we're going to talk about here today, which is really more on an industry level and focusing in on a lot of the major players within those regions. Though I did take those four regions and recombine them into two particular regions, which you'll see the reasons why when we get to it. But other things I've been working on. It's obviously been earnings season, and this is also 10K season. So I've been really kind of trying to gear up to make significant updates to all of my valuation models for my major holdings as their 10Ks come out, because there ends up being usually some details in the 10Ks that aren't in the 10Qs or the earnings releases throughout the year. So there's usually just like a couple minor details that are really useful for my models that come out whenever those annual documents come out. So I'm really kind of trying to be prepared to make those updates as things come out. Like for example, in particular, we already got Generac earnings, and I'm really kind of keeping my eye out for the 10K, which I expect to come out here this week. So really looking forward uh, to that particular earnings and to be able to take a look at that 10K document. Also, in mode they reported, and I'm looking forward to the annual document for them as well. That is going to be pretty key. Generac, I'm very curious. I've kind of gone back and forth a little bit on exactly how high of valuation I place on them currently. I've done a lot of adjusting to all of my major holdings. As I, in particular, in the last week, I've made some significant adjustments to how I've been calculating my cost of capitals, my cost of equities, my discount rates for my valuations. I've been, ever since I reworked my valuation template, I had kind of changed things around in terms of the discount rates. And in the meantime, I had just kind of been relying on relatively low discount rates, really not that much higher than a risk free rate in the short term, and kind of moving towards really just like a market cost of equity or cost of capital discount rate in the long term. But even that was a generally lower discount rate than I had used historically. And so I had just been much more conservative on the cash flow end to kind of back that up. But I kind of knew that at some point I wanted to make some sort of uh, systematic approach to what how I wanted to do discount rates going forward. But nonetheless, I still kind of wanted to change it from what I had done more historically. Historically, I had used a kind of an adjusted CAPM beta approach. The adjustment aspect of it was pretty significant, so it was very, very different from a traditional beta. It really had a lot of adjustments going on to it to sort of stabilize it, as well as disconnect it from specifically market volatility as a measure. But nonetheless, I still kind of wanted to change away from that because really all the adjustments I'd done had really kind of like I would say over engineered the process, so to speak. So I've been kind of looking for something that's a little bit more tangible, a little more based on cash flows as an approach to measuring discount rates. And I've kind of come up with a approach I like, which has to do with thinking about one, the actual returns to debt and equity in the form of interest, dividends, and buybacks, but also thinking about buyback authorizations as well as cash balances relative to historical ranges as kind of a way to think about what is like the equity drag on a company and thinking about that as the cost of equity or the discount rate. And anyway, so the point is I took this approach and I've changed my discount rates around, which meant that I've kind of changed my valuations around. So there is some significant changes to the valuations for pretty much all the companies in my portfolio, which here on the portfolio sheet is not really a super easy way to look at that. More to the valuation dashboard, you can kind of see at least what they all look like here in this way. I haven't changed that approach to all of these valuations, really just the ones that are in my portfolio. So really the ones that are marked purple here. And then I plan to do so for the green ones here, which are not in my portfolio, but are ones that I've had, major models and valuations on. And these are ones that I have good confidence in the models, or they're related to themed industries that I want to focus on. And then there's a good chance that the other ones that are not marked here, I might be getting rid of off the list. There's one or two more I want to keep. Like maybe I'll probably keep Amazon. I still kind of like keep a good look and focus on Amazon, even though they're significantly overvalued. I really like them as a company. So it's like one of those things where if they did become a good valuation, I would really hop at the chance for them. Um, and then I had Cisco Gold royalties in my portfolio very recently. They were one of the ones that I had made some a quick move on in terms of looking for new gold holdings when I discarded Barrick as a holding because I was focusing a lot more on the quality of the gold assets. And Cisco I liked, but I had kind of changed my assessments of the valuation around relatively quickly after making that position, so I did hop out of them. Which I mean, you'll notice that in my portfolio here, they're no longer here. But that kind of gets to some of the other changes that I have had in my portfolio, which is that I have added a new gold miner here, which is Orla mining. So instead of Cisco gold royalties, we now have Orla miner, and which you can see here, there's relatively small 1% so far, but my targeting system is now for up to about 4% for them. So I'll probably be adding to them as well. And then honestly, I'm looking to potentially add some more gold miners, and that's some of the other stuff we'll talk about here today is gold mining. Because yeah, I know that it's not an industry that a lot of people like to focus on, but I'm just getting more and more bullish on gold mining. One, there's the gold price to take into account. Everyone should take a look at that. Gold has been on an absolute tear lately, and of course, if anybody who's not super familiar with gold markets and has like a deep understanding of what's going on in gold markets might look at this and be like, oh well, does that mean there's going to be some sort of big pullback or crash at some point? And it's like, well, that's very, very, very possible. Historically speaking, gold has often had some pretty big sharp move upwards, and then often had some pretty significant declines of like 50 to 70%, sometimes even from those highs. Sometimes it's closer to more like 50% or something, but it kind of depends on the cycle or whatever. So it's like it's not unreasonable to think that that actually might occur at some point. But nonetheless, if that was to occur, it's from the peak point where we make that measurement. So the basing is still significantly higher than was in previous cycles. The reason why I bring that up is because like we'll talk about it when we get into the gold miners, but like a lot of gold miners value their own resources and reserves at certain gold prices, but they're usually extraordinarily conservative in how they move that price up, that which they're valuing their own resources. So the point is that like if you're looking at them on a reserve and resource basis, which is a pretty common way to do it, it's sort of similar to thinking about them in like a price to book kind of sense. You can very, very significantly underestimate the value that they have if you are not reasonably bullish on gold as a price itself. I would say it's like if you really believe you're going to mean revert that hard. Like most the gold miners, for example, right now value their resources or their reserves at like a 1700 level or like a 1900 level. I think I've seen a few go as high as like 21 or 2300, but really it's like 1700 to 2000, I think, is where most of them put their reserves, which is already a significant move up from, like, say, if you had looked at where they were valuing their resources and the reserves back in like 2021. Most of them had their resources and reserves at like 1200 to 1500. So it's like just one of those things where it's like if you understand the dynamics of the gold market, you don't necessarily need gold prices to stay exactly where they are currently for there to be significant value with on a tangible net asset basis, so to speak. But then obviously you can value the cash flows more specifically, which I do for a lot of the miners, and I've been doing a lot of that this week. I've been very specifically getting a little bit more nitty gritty on miners than I have historically. I've gotten very precise down to like the mine level of trying to project cash flows for a couple companies before, but I've never really done it super broadly, and that was something I kind of did this weekend. Is I actually did down to the mine specific level, project out cash flows for a pretty significant amount of production. I would say it's like I was doing I did a rough kind of napkin calculation before starting the stream, and it said that I basically have valued about 1.8% of the global annual production of mines, which doesn't sound like a lot, but there's a lot of mines. So like I'm pretty satisfied with that level. But anyway, we're getting super far ahead of ourselves because I didn't really want to talk too much about miners just yet. We're going to want to focus more on housing first, but I, like I said, trying to explain the differences in my portfolio. And so we did add Orla Mining, and I'm actually looking to potentially add some other miners here in the near future. I'm really kind of just focusing on the total mining exposure overall, which like so far I'm kind of at like 12 to 13% of my portfolio is in gold and mining. That includes the gold ETF I have. So I think as long as I keep it below like maybe about 20% as a total, I'll be satisfied with that, because I do also have like about 15% in insurance, or I think I have like 18% in insurance, but the targeting system wants me to have like 15%. So it's kind of similar to what I have in insurance, and similar to what I have or am potentially going to be having in industrials as well. So it's kind of similar on like an industry grouped basis, which is something I've been thinking a lot more about. Is because I had been re rejiggering my my allocation system quite a lot over the last year or two, or really like I've been kind of constantly rejiggering that pretty much ever since I started investing. But I have refigured that again in a way that I'm pretty satisfied with on the individual company level. But the point is I was kind of hoping to make it so that there would be even higher levels of concentration. Like I was looking at FG in particular. Like part of me kind of wanted to have up to 15 to 20% in FG, which is a little bit of a biased way to look at it when you're kind of designing a targeting system to like have a specific company in mind for what you're trying to target towards. But this thing is like I could reconfigure my targeting system to get that result, but it often got me other results that I was less satisfied with some of the other companies. So it's really kind of like trying to find a system that makes it seem appropriate for all your current companies, and then that kind of gives you confidence that the next company you add to your portfolio, it'll be a somewhat accurate targeting system for that as well. And then I like, for example, I kind of had these questions as well with the home builders, because like ever since I added Lennar to my portfolio, it was giving me a relatively strong target for them as well. As I continued to refigure that as well, and that was one of the things I was a little bit less certain on, because I I'm bullish on home builders, but I'm also somewhat uneasy about the industry, which is one of the reasons I've done so much work on the industry, both on kind of like a larger macro level and more on a micro company level as well. Is that I'm really trying to make sure that I'm not fooling myself hopping into the industry. And like, my targeting system also seems to believe that, hey, this is something you might want to put a lot of capital towards. And that's just one company, 8.3%. So it's pretty good. That would make it my third largest targeted company as it currently stands. And we can compare the actual expected upsides for those companies as well. For example, like with Generac, it's only 15 to 16%. Lennar it's 25%. FG we have 27, 28%. And so, you know, differences in the upside potentials over there. Though I should point out that technically the targeting system doesn't really focus on the upside. It focuses more on the COGR in terms of like what aspect it's kind of calculating there. It takes into account certain what type of strategy it is, whether it's like a theme based industry approach, or if it's just a value company, or if it's neither of those things, and has some other factors into it. So it takes those things into account, but then it also takes the expected COGR into account with an adjusted Kelly formula. Hey, Jack. Let's fucking go. ITB. Yeah, thanks for reminding me. I was actually going to bring up ITB in the context of talking about home builders. Because, yeah, I mean, this kind of paints a picture partially of some of the things I was talking about, where it's like, you look at the run up right here, and so there's reasons to be careful and skeptical given the run up. But I do think that if you look at a lot of the actual fundamental economic data, the actual dynamics of the industry, that there's just a lot of reason to continue the bullishness nonetheless. And then if you look at the kind of recent performance, it's like, well, there has been a pullback here. So it's like, maybe they were a little bit overblown up there, but maybe down here they have maybe as an aggregate come back down to a more appropriate level for the time being. It's at least kind of at the same level it's been for uh, well over a year now, not quite a year and a half, but over a year. It's come back over it's a year level, but that's only 1 year on a relatively strong run up. So it's one of those things where you can kind of think about that. So it's like, I've kind of tried to think about it in that context as well. Some of the home builders have come down more than others on that kind of comparable basis. I mean, maybe throw Lennar up there. Yeah, like Lennar's come down a bit more depending on, obviously the starting point. It's like if you zoom back far enough, Lennar is probably outpacing them, or maybe only at uncertain time frames. Looks like they're at best keeping pace with them on a lot of basis. So it's like, yeah, you could, that kind of maybe gives credence to the belief that Lennar is a decent bargain. I will also say that because like I think the last time I had gone live, or the time before that, I had shown when I had first shown some of the builders I had done some quick valuations on, and I had shown that I thought a few of them were undervalued, and I was like, wow, they're kind of like looking good as a group. I will say that with the kind of regional data that I've done, and the regression I've done on housing starts to kind of come up with estimates for what the market should look like, and then using current market shares as kind of like a way to estimate revenues. I've done that for a few of the companies now. Not all of them in this list have I done that for, only for Lennar, Green Brick, and DR Horton. So like I would say that those valuations I feel reasonably accurate about. But the other three, not as much. KB Homes, Century, and Taylor Morrison, I don't really have as much confidence in those valuations, I would say. But the other three, I have reasonable. I would say I have reasonable confidence in those valuations. They're using basically the same consistent approach, and just kind of applying differences in their margins and differences in their market shares to the kind of the same modeling approach. And so you can see Lennar is significantly better of evaluation and expected returns, and also has a net cash position, which should make you feel a lot more at ease. I would say. I'm not going to get into all the details about the valuation here today. I'm kind of planning to do, like I said, a video at some point, maybe here in the near future for that. But yeah, so the point is I did bring down some of the other valuations on the other builders as I've kind of adjusted over time, which gives me, like I said, makes me feel even better about Lennar specifically, not even just in the context of like, well, home builders as a group as well. Green Brick, I was very interested in because it's a bit smaller, and I really liked a lot of the details about its asset quality as well as its management. So I was really kind of hoping to find some really good value there, which I mean, looks decent, like I said, give it using that same approach, but nothing amazing. And then DR Horton, previously I had seen Lennar and DR Horton as kind of like both having significant upside. But now with, like I said, this kind of using this same modeled approach, DR Horton doesn't look as attractive to me. Just doesn't. Which I mean, I don't know. Let me throw them up. See how that looks. you kind of get some similar gaps, maybe not as much. I guess that kind of depends on your starting point a little bit. But I would say maybe not as much underperformance relative to ITB compared to like where Lennar is. But like I said, there's a few points where it gets pretty down there. But yeah, so yeah, that's at least my like I said, I have pretty strong thoughts on these three as far as like what these valuations show. Feeling strong about Lennar. You can see that 13% COGR is what I'm seeing. Net cash position, strong insider holdings, strong upside. Yeah, I'm liking it. I'm liking it. So yeah, coming back over to the portfolio where you can see I have a reasonably high target for it. Yeah, feeling good about that. Feeling reasonably good about that. It's going to be, that would make it my second to third largest position. It would basically be the same size as PayPal if I went up to that size immediately. Though I'm potentially considering trimming PayPal at some point here in the near future. So I am over target, as you can see with the new targeting system. But I mean, I don't necessarily pull the trigger on selling things immediately when something's over target. So that's just the other caveat to that. It's more of a guideline. But PayPal is another company in the same camp of, as I was saying, where I'm really here in 10K season, hoping to do some significant updates to my model to really kind of make some finer decisions about what I want to do on that. But I do think yeah, maybe it is time to kind of do something and get out of PayPal. It kind of does suck because it has come down a bit in price, so I kind of wish I had maybe pulled the trigger on that a little bit. This is one of the reasons that I'm not super quick on that, because it has come down. So it would have been nicer if I had kind of decided to pull that trigger at 90. I know some of the people in the server community specifically that did do that, so good on them for making those moves. And so part of me is kind of hoping that it's just gonna hop back up to those areas, or at least maybe up to the 80s or whatever. But we'll see. Like I said, I'm gonna rework the model and then make my decision after that. That's kind of how I am in all these with all these companies to a certain extent, because I have that same attitude about Generac as well. Looking at them and being like, well, I mean, what do we want to do with that? What kind of upside do we see with that? Initially, I had kind of like been reworking the numbers and I saw a bunch more upside, but then, like I said, I kind of did the adjustments to my discount rate methods, and that kind of brought it down a little bit more. So it's like, it's upside, but not amazing upside, not amazing expected returns. But maybe after I go through the 10K and kind of rethink the model a little bit, maybe I'll update it from there. So we'll see. We'll see. So that's kind of where I'm at with some of those other kind of like legacy positions that have kind of my larger legacy positions in mode. I have updated a lot of the stuff on that. I still kind of want to update my model, but I've at least input the most recent numbers. So I do need to update the model a little bit, but that one has a lot more upside to it. So it's not one that I have the kind of this like wishy-washy. I don't know as much how I feel about it. It has very strong expected return. So we're kind of just sitting and waiting on that one. That one, the thesis has transformed admittedly over time a little bit, but it's nonetheless still in play. So we're pretty good on that. The share count is coming down at a pretty fast clip now. And I'm expecting growth to return. Maybe not really that much this year, but certainly going into next year, I do think so. There's that. Um, just pull the 20-year chart to get a better picture. I'm not 100% sure which one you were saying that for. Maybe that was ITB, but Baba Wen. I'm not that interested in looking at Baba, honestly. I'm just not. Like I said, I'm very focused on very specific things. As hence the kind of the title of what we're talking about here today. It's like I have a very specific camps of things I'm focused on, and then like once I've filled up my buckets of those things that I want pretty significantly, like I want to have a lot. Like I'm very focused on annuities, insurance as is, but I'm still very focused on that. I'm kind of trying to fill up a certain type of industrial bucket to a certain extent. I'm trying to fill up my gold mining bucket to a certain extent. Trying to fill up my home building and kind of related construction industry stuff to a certain extent. And then once I have all those buckets filled up to the amounts that I want to a certain extent, then beyond that, I'm just gonna start looking at like more like deep value stuff, which I will say, like that's a lot of stuff that you kind of throw my way a lot of times. Is like you see stuff that you think is really cheap and you want my take on it, which is why I haven't been super responsive for the record lately. It's just like I'm just so much more focused on this like different approach where I'm very much focused on longer term industry groups that I want to have like a certain amount of exposure to. But then once I have done that, my plan is to kind of be focusing more on some real deep value stuff beyond that. Uh, I sort of know you're teasing. I'm just answering the questions nonetheless anyway. Replace my SPY puts with Palantir puts for better beta exposure. I mean, there's a solid argument for that. But my usage of puts is based on certain back tested models of things that I've kind of like done a lot of research on. So technically, if I was to deviate from using SPY puts, I would be deviating from whatever results I got from the model. You could argue that the stronger beta exposure could theoretically maybe work, but it could also blow up in my face faster too. Is the is the point there? Because my puts are hedged, so under plenty of circumstances, they are not expected to have positive expected returns. They're only potentially have positive expected returns if my models are halfway decent. Which I mean, it's something I've been learning over time. I've been using puts like this for a few years now. And when I first started, I was using very rudimentary approaches that were not very effective and definitely lost me money. But now I've gotten, I think, a lot better at building models. So what's the structure of the puts? Well, they're 0.5 delta, 30% out of the money, usually in the range of like 30 to 40% IV is kind of what I'm going for. But just deep out of the money puts. They vary a little bit. The specific maturities I go for, it also varies a little bit. Typically, I aim for about 3 months, and I hold it for a month. Is kind of the general approach. And then, like I said, I'm using certain models on the S&P 500 to kind of dictate when I buy or don't buy. But that's kind of the strategy in a nutshell. It's a little bit complicated to explain. I have to pull up the regressions to kind of explain. But I've been experimenting with various kind of quantitative like models. And then the way I usually kind of try to get exposure to that is either through SPY puts or actual trading in and out of VU, which is kind of like what the large VU holding is. Which I mean, technically, that's also to make it so that I'm just not holding too much cash, so that like I can kind of have the right targets that I want for my companies, while still not holding like a ton of cash because I don't want to have 30% cash. So I do have a target for cash as well at 3.1%. So that like that's the literal cash amount I want, which technically I'm over that level right now. I do want to hold VU, but I also try to pay attention to certain dynamics in liquidity and volatility because I am concerned about downside. I'm willing to not get the full VU returns in order to essentially it's meant to just get better returns in cash. That's the idea. It's like we're really just trying to improve the cash drag returns while essentially still providing potential capital for when these things go down. So the idea is like if we're going to have a market crash, I am willing to get out. It is a momentum based strategy, effectively speaking. Is this portfolio meant to expand beyond these core holdings? Well, what do you mean specifically by that? I am trying to find more positions. If that's what you mean. Ideally speaking, I would basically have zero VU here. This is just a placeholder. So if that sort of answers your question, in a sense, there's like 27% of unallocated capital. Well, also technically I'm like 2% over my cash level as well, but I'm a little over or under some of the other ones as well too. So it's like if we netted them all out, I'm not exactly sure where I line up to, but ideally speaking, we wouldn't really have much VU here. There is a target number here, but technically this target is just the leftover amount of all the other ones here. Like there's a target for the gold, there's a target for the cash, there's a target for the puts, and there's a target for everything else. But then the VU ends up being just the leftover amount for that. So like it kind of implies that I want to hold a huge amount of VU, but I don't actually. So yes, I'm technically always looking for new positions, but I'm looking for ID like I was kind of saying first, I'm looking to fill up certain types of positions more. Like I show here on the strategy pie here, I have the theme camp, and so that's the one that I'm kind of what I'm talking about, where it fits into a specific long-term industry theme base approach, but it's also a value company. No, we're not like buying something that we think is overvalued because it's in a good industry or anything like that. It's just that it fits this long-term growth perspective as well as the value camp. But then there's just value, which means it's just value. For example, I would say that applies to InMode. InMode is a cheap company. You could, in some ways, it works to some things. The work it kind of fits a little bit into some of the theme based camps that I'm interested in, but not very strongly, and it has a lot of risks associated with it. So it's not something that like I'm super enthused to hold for like a whole decade. It's like if I could get rid of it in another year because it got a significant pop up, we would be more than happy to kind of part with it. But we're also happy to hold it for a few years too, where it's not like we consider it to have that high of a risk. So that's kind of like the difference between the two strategies there. So it's like we want to get rid of this bar here as much as we can, but we are focusing on, I would say, getting this slice. Like it's currently at 43%. I want to get it at least 50%, but ideally I would like to get it to more like 2/3 of the portfolio. That would, I think, be kind of around where I'd want it to be. And so then the rest of it, like we have 2/3 in kind of like theme there. We'd probably still have like 5% in cash and hedges. And then so then that would leave like another 25% to be kind of like more deep value kind of stuff from there. So that's kind of like what I envision my portfolio looking like from a kind of a strategy perspective. But like I said, it's something we're kind of slowly moving towards. I didn't see what those last comments were. Funny how with 27% VU, you have like 10% total portfolio position in Mag 7. Yeah, right. No, for sure. One more reason why we would like to kind of have less of it. Which I mean, that's one of the reasons, like I said, that it's not just a buy and hold position for my VU approach. Like I'm watching the market every single day. There are specific signals that I'm looking for where I will pull that thing to cash, or I'll pull half of it to cash. And then if the signal goes like full strength, I'll pull the whole thing to cash. So it's like it's in VU right now, but there are like 1 to 5 day periods where you'll see me at like 25 to 30% cash because I did pull the VU out because we're we're not looking to go down 10 to 20% with the market because the Mag 7 AI hype decided to finally crash out, you know. That's basically where we're at with that, which you know, to each their own. I know a lot of other people don't like that kind of approach with it, but the point is like this portfolio is meant to serve the individual holding. Like I said, it's like this is meant to just reduce the cash drag and nothing else. So if we think it's time to step aside because the liquidity looks like it's disappearing real quick, that's exactly what we'll do. Uh, get ready for a possible Generac media bull run with Southern Freeze hitting soon. I mean, I'm always hoping so. See, that's like one of the fun ones. One thing that's been good about holding Generac, I will say, for while I've had it, is that I mean, obviously you don't want to be celebrating other people's turmoil, obviously, but it is kind of a fun one to see go up on days where there's like bad news going on. Oftentimes not necessarily the type of news that like affects the rest of the market necessarily, but it can be kind of a funny, weirdly correlated one. And I like that exposure. That's one that, as because I was talking about my thoughts related to that position a little bit earlier, where I was saying like I'm waiting on the 10K with that one. It doesn't have a ton of upside to it from my perspective, but I really do like the niche it fills within like the industries that I'm focused on, and I haven't really found a good replacement in that category at all. And I haven't really gotten to looking super closely either in a while. I've been so much more focused on other industries that you can assess much more as an aggregate. See, like gold mining, you know, you can think about that whole industry just as a whole. Home building, you can think about as a whole, much more easily. Whereas like industrials, it's like industrials are so broad and like and have so many different things to it. Even electrical industrials, which is kind of like the camp I kind of put that in, and is the thing that I'm interested in.
even that is still varies quite a lot. So it's not something where you can like put 20 electrical industrials down and then get like all the same metrics for them very easily and compare them all to each other. It's like really they're all selling very different types of products to very different customers for very different use cases. And so yeah, it's like it's a little bit harder to do the industry analysis. So I've kind of been somewhat putting it off because I know that it's going to require a lot more like idiosyncratic work essentially. But that is something I've been trying to definitely is on my plate to kind of get around to because I really like Generac, and it's like if I do decide that it's time to sell out of them, it would be a shame to essentially not really have that industry camp in the portfolio anymore, so to speak. So yeah, I'm always looking for another interesting electrical industrial. Various people in the server have certainly put various ones in on my radar. So it's like I do have kind of like a list of ones to look at. But like I said, it's like it's just that they all require kind of very idiosyncratic uh research. You can't really do research on a ton of them all at once very easily with that industry like you can with home building or with gold mining or with copper mining or with annuities and insurance even to a certain extent. But yeah, either way, so that's kind of where I'm at with Generac. But yeah, hoping for freeze catastrophe events. And then that's the thing is like once we roll out of that season, then we start to roll into the spring summer season, and then it starts to be the question is then about hurricanes and power outages. So that's kind of the thing I was trying to get to saying about Generac is that it's kind of there's always some catastrophes on the horizon that's going to be a potential winner for Generac because our power grids are just garbage, which is the one of the key macro trends that this industry we're trying to capture on the electrical industrials. The reason why we're interested in electrical industrials is because of power grid weakness and the need to further electrify the grid due to industry trends. Is like there's positive trends and there's negative trends that kind of work both in favor for electrical industrials. And this one's kind of a unique electrical industrial because it's a form fitting solution of of natural gas usage within homes, which is so it's a little bit of a very kind of unique dynamic of one. Which, by the way, some of those details too also I think makes me somewhat bullish for Generac potential in the future too, because I do think that one potential thing that we can almost for sure see out of the Trump administration is probably some more production of natural gas in the United States. There's a lot of reason to believe that they're going to be trying to push the energy industry forward in a lot of different ways. But the U.S. natural gas is very prolific, and so if we get more push in that regards, that makes it cheaper, and that's going to make it easier for people to use, which is going to make it easier for Generac customers to find that to be an attractive solution for their problems. So it's like that's just another reason like I said is like that even if the value doesn't look amazing on Generac from my perspective, it's like I'm just not in a rush to sell it. Like I'm really like it's like I'm looking for reasons to want to sell it, and like I actually find reasons to just kind of like want to hold on a little bit longer. But yeah, and that one's come down a little bit too, relative to some of those peak levels. So that kind of help. That's also in that same camp. Actually, it's come down more than PayPal has, as you can see. So it's like that also is like well, if I was gonna sell it, I should have sold it before kind of mentalities too. And because I was having these same thoughts then too. It's like for at least when it's there, it was actually overvalued from my perspective, right? Like I was looking at that and really being like, but like I said, it's like I just there's just a lot of details about the macro environment in the industry that makes me be like, God, no, we really got to keep a hold of that one. And so yeah, and it's performed well for us, 30% on annualized money weighted basis. So we're doing pretty solid on our returns with that one. We're definitely not shy on that front, which is kind of true of a lot of other things. Even with PayPal having come down, that one's at 20% as well, which that's 20% annualized for 1.3 years. Generac 30%, 1.4 years. Uh, so anyway, so we've talked a whole lot about my portfolio, a lot more than I kind of intend to. Jack definitely kind of threw the right questions, kind of to ask, make me talk about my portfolio a little longer. We can get into some of the housing stuff a little bit more further. Jack, never thought of Generac as a climate change hedge. Definitely gives it a valuation premium. Yeah, exactly. Exactly. It's like, I remember like when I mean, you can go watch the video I made on Generac way back when, but like, yeah, no, like, and that's the thing is like, I've talked about this with some of the other people in the server. It's like Generac is one of the first models I made that I think kind of like, it wasn't, you know, I was kind of like, I was already building models and things, but it was one of the first ones that I think really kind of took this approach that I'm now much more focused on, which where I was really thinking about the industry and the macro dynamics, and really trying to paint like a really solid story over a longer period of time with it. And then I kind of did the same thing with FG as well. And then like basically ever since those two, I've really kind of tried to do that much more with a lot more of my valuations. And like, you know, sometimes things are just a valuation play and you don't really have like a really great industry story for it or anything like that. But like that's ever since those ones, like Generic was one of the first really successful ones I came up with that. Cause like I remember when that picture kind of clinched for me once I saw it that way, where I was like, oh, this is something that's going to be like a great hedge for a lot of really bad scenarios that I also had a lot of high confidence in. Like I said, like I have the power grid weakness is just like something that is practically like a rock stone in my mind of like a place to look for potential in markets now. Something I really focus on. So yeah. Um, I know the FG thesis is based on aging. I really want to get long-term care exposure because I anticipate long-term care spending to blow out. Yeah, no, long-term care. I've looked at a lot of things in that area. For that exact reason. There's a lot of reasons to think about that. I will say it's like something because I brought it up to a few people in regards to FG. It's like one of those things where it's like the thesis is still intact about the demographics, but it is something that will you know, pun intended, will itself age over time. Right. So it's like we will continue to have. Let me actually pull up the thing I made for this. It's like gotta kind of pay attention. It's like here's the expected populations according to the Census Bureau here in the United States for the total United States as of certain years. So like here's as of 2020, 2025, 2030, 2035, 2040. So in 2020, it was expected to have 339 million people in the United States. So as of right now, 347 million. 5 years from now, 355 million, 363, 370. You can see how it goes from there. But then I have like the different groupings by different age groupings because they do make projections based off that. So I basically like I'm focusing on like FG in particular. They're focused on people who are like going into retirement, and people who are near retirement. So that was kind of like the target groupings I made for this. For long-term care, you would want something that's maybe a little bit older than that. So it kind of gives you maybe a little bit more of a buffer for that. But anyway, the point is I'm trying to make here is that after 2030, my target grouping, which was basically the 10 years prior to retirement and the 10 years going into retirement, it was kind of like that 20-year grouping. That grouping is going to start to decline in population after 2030. Not very quickly, about 1% or so over 5 years in total, not per year. So like 0.2 per year or so. And then it kind of levels off a little bit at that point. And like I said, I haven't looked at the specific dynamics for like maybe like the next grouping that's slightly older than that, which would be more focused on the higher than that. Yeah, because that's your question there. Where's the 74 plus population? I don't have the 74 plus population in this grouping right here because they weren't in my target group for FG. FG, like by the time you're 75, you're probably either gonna have bought annuities or not. Basically, it was kind of like the way I looked at it. So like I didn't include them in this grouping because I wasn't focused on that particular group. So like for long-term care, you probably would want to have that grouping in there. But I just didn't, I was kind of focusing on a more specific subset. But anyway, the point is I was trying to make is that like after 2030, those groupings look like they're probably going to level off. They're still pretty significant in terms of the total size of the population. Cause like here, this is like the total percentage of the total population. So it's still going to be like leveled off at like 22% or so at that point, which is still high relative to history. I don't want to go to the website to like look at that, but like if you looked at it over a chart, it's still up at like decades highs. But it's like the growth in those population groups is starting to level off. But like I said, it's like I don't know how the projections look for if you included 75 to 79 and 80 to 84, because if you included those groupings, it might add like another 5 years onto the picture. But also maybe not, because that's also the group where people start to die off quicker too. So I don't know. Like I said, it's like I didn't include that when I was making this table, because like this is actually the start of an FG model. I was actually like building up a relatively simplistic new kind of a approach to an FG model based off of this. This was kind of like the starting point I was doing for that. So just something to think in mind, just something to just point out is that the boomer long-term care thesis is solid, and everything. Like I said, is like it's still going to be a huge portion of the population and a huge portion of spending for like the next 20 years, right? But the growing part of it is going to level off by 2030. That's, I guess that's the long and short of way of what I was trying to say. So anyway, let's move on from this. I did want to get into some specific housing stuff. So like last stream I did, we talked a lot about all this data here, where I kind of like showed a lot of housing data by the 4 different census regions that the U.S. reports by. And then I had mentioned that what my plan was is that I was going to regroup them together, where I was going to have basically just the West and then an East grouping, and then the East was going to be comprised of the South, Northeast, and Midwest, which was going to make the East a really, really large grouping. It was going to make basically like the East like 65% of the market, and then the West like 35% of the market. Which I had, like I said, I had mentioned that I wasn't really a huge fan of doing it that way. But it kind of came down to when I was looking at the different companies that I was planning to analyze. I saw that they themselves had very, very peculiar regions that kind of made it difficult for me to do in that way. Very specifically here. Some of them were more friendly than others, but Lennar, which was the one I was most interested in, had their regions split up like this. Like it doesn't actually show what the regions are, but like for example, Lennar has like one West grouping that's like here. Then they have Texas by themselves. Then they have this like central region here, which is strange. It's like this little like mid strip here, and then this like other kind of like East grouping, which includes like a couple of these states as well as these guys here. So it's like their segments were split up in such an obnoxious way that was just like, why would you do this? Like why would you split split things up that way? So like ideally, if you would ask me, like I would have preferred to maybe have like a West, an East, and then like a Midwest or something. Like that would have been fine for me. And I mean, I would have been fine just keeping it like the regions that the census region keeps it as too. But whatever. The point is like the only way I could make it conform very well to Lennar specifically was the worst one out of the group, but the other ones had difficulties too, was to basically just make like an East and a West. So that's what I did. And you know, it kind of works out fine, I think, as well, because of just some of the dynamics between the different economies in those regions. Decent places to be building. Talking about like Lennar's focus in particular. Yeah, I would generally agree with that. I'm a little less hype on these states. Less hype on some of the dynamics of these states, but I like in general. I mean, I've kind of said it many times before, I'm pretty bullish on basically the southern half of the United States in general. Like this is kind of like the areas that I'm bullish on in a nutshell. So it's like as long as you got really solid exposure to that, I'm happy. But then, like I said, it's like if you focus on the different segments, you might say it's like, okay, well, where does things split up in that regards? And Lennar has a pretty strong focus on the West. So I find that to be good too. And then I would say is like as I look at my last stream from 2 weeks ago, I go into all the finer details between the different regions, but like there is pretty significant differences there. Like the South is like the really, really large market. The West is one of the faster growing markets, but the West and the South are both the kind of the faster growing markets kind of together, but West probably more than the South. while the South is just larger in general. And then that kind of conforms pretty well to just the population differences between the two. That kind of makes a lot of sense. But anyway, we can get down into some more company specific stuff, which is kind of the newer stuff I've worked on since the last stream, where like I have gone through and broken down all the segment data for DR Horton, Lennar, Pulte Homes, NVR, and then I also added KBH to the group. I kind of went back and forth on like which was the smaller extra one I was going to add in. I was originally just kind of planning to do like the largest 5 or 4 or whatever, but then I kind of like the last one I didn't pick like the next largest one. I ended up picking KBH, partially because I wanted to have a better split between the regions. The ones I ended up picking had a lot more focus on the east, so I wanted one that was a little bit more focused on the west, so I ended up going with KBH. But either way, so a whole bunch of data with them, and then like I said, I kind of took all of their individual segments and then kind of recombined all those segments into west, and then east, and then kind of like recombine them in together, and then we kind of have like aggregated data for the east and west itself. So here, let's see, let me go to over to the graphs. It's a lot of sheets, so I have to kind of remind myself where everything is. Okay, so here, let's see, east. We'll take a look at the east first. So this is the east. We have the DR Horton, Lennar, Pulte, NVR, and KBH. This is the prices. So this is their average selling prices, specifically for new orders. So it's actually not technically for the revenues. This is specifically for new orders, which conforms with housing starts. So technically, like these prices that are listed here, some portion of them are going to be canceled. Some portion of them are even going to be renegotiated a little bit. These technically don't funnel down to the revenues precisely. But these are kind of like the first indications in the market of the potential sale. So essentially, it's kind of like the thing that people are looking at when they're looking at like prices that are being listed. So that's kind of like why I'm focusing on that too, because like I included like a lot of that data, both of the kinds of those data for most of the companies. Like if you look in here, like I end up looking at their deliveries as well as their new orders. But like when I was kind of putting the charts together, I was like, well, we're just going to focus on like one of them altogether. So I'm mostly focusing on new orders. But anyway, so prices here, you can see that in the east, Pulte Homes has some of the higher price averages in general, with NVR kind of being the next highest, and they're pretty consistent in that way, going backwards all the way to 2016, like 1 or 2 years where they're kind of dipping below that. With DR Horton being kind of the cheaper between the two as well. And then you can see that KBH and Lennar are kind of like more middling. The interesting thing is how pretty consistent that is across the years. Like they don't really deviate across each other, which is pretty interesting. It's like some of these metrics deviate a little bit more than others, but it kind of just shows like the bifurcation within the market, where it's like, like one company, if they're going to be having a significant market share focusing on one price range, well, then it kind of like disincentivizes another company to be super focused on that if they have a larger market share. These companies only have so much of market share, and there's going to be a lot of smaller companies with like super micro fractions of market share, and so they probably will compete more with those ones as well. But the point is, like the bigger boys in general will kind of spread out their price ranges so that they're not competing in the same price ranges in the same areas. Though it varies by area. You'll notice that when we switch to the Western region, which ones have the higher price ones versus the lower price ones is not necessarily the same by the region, which is one of the reasons we're doing all this by region, because it does make a big difference. So anyway, those are just the prices. Now, if we actually look at the market shares themselves, here, over here, so a little out of the way. Here you can see the actual market shares. DR Horton being the larger market share in general, and then I also have here the blue line, which is kind of like pretty next to the DR Horton, is all of them together. So this is all 5 of them added together, and that's on the right axis here. So like all of them are on the left hand axis except for that. The reason why I included that is so you can kind of get an idea of the concentration within the larger players as a whole, not just see the market shares of these ones compared to each other. So like as I was saying, like DR Horton, the larger market share up to almost 9% in 2024, and then Lennar has almost 7% in the East again. Which again, the East is a very large portion of the United States. It's like 2/3 of the land and like 3/4 of the population or something like that. But then below them, we have Pulte and MVR, which are kind of roughly the same, close to 3%, and then KBH, which is much lower at like 0.5% to 1%, depending on the year you're looking at. But then the other thing I kind of wanted to focus on, like I was saying, is like the reason why I include the grouping as a total is to get an idea of the concentration. So you can see that over time, the concentration has moved up. We've moved up from 14, 15%, close to up to 19%, and then it kind of dipped down a little bit, but then it moved up solidly over 20% in 2020, and then up to 20% in 2023. Don't have a few of them for 24, so I have that listed there. But the point is, it's a pretty solid uptrend. Now that uptrend is pretty concentrated in DR Horton and Lennar. You'll notice here too. Like these three, the next three below that, they have not really budged in terms of market share, and KBH looks like it's actually even come down a little bit overall. So it's like really that concentration is happening, but it is pretty focused on these larger players. Now that's obviously pretty good to show for Lennar, which is obviously my my kind of favored contender valuation wise as of right now. Anyway, I guess that could always change over time. But so that's good to see. But there is a larger growth in that concentration. Now I didn't do the exact math on the differences the smaller ones have relative to the larger ones, so I didn't like see like what percentage of this change is due to just DR Horton and Lennar compared to the smaller ones, because I kind of wish I did, because then that could kind of answer the question of whether or not they're stealing significant share from just smaller players, or if a significant portion of that is just the smaller declines in the shares of these ones all in together. But it does have to be a pretty significant amount from the smaller players. And I wish I kind of had the data of how many total home builders there were in the United States by year as well, because I'd be curious to see that, because that could create further catalysts for growth within the model itself. Now, like I said, I'm not getting into all the details of how I built my model and the valuation for Lennar specifically, but there is a decent amount of kind of mean reversion built into the model. We're not really assuming anything super fantastic in terms of like the growth of various populations or market share or anything like that. We're really just kind of assuming everything kind of continues as steady state, and that we're kind of keeping a relatively consistent level of home building consistent with population growth, and not taking into account, like for example, the fact that we may have underbuilt for a certain amount of years or anything like that, or growth in market share. So anything like that you would add on to the valuation would essentially be further upside. So that's kind of why I'm bringing that up, is because like the growth that Lennar has had in market share is pretty significant. They've like more than doubled their market share in the East. And my valuation does not assume that there's any further growth in market share. It doesn't assume that it drops in market share either. So that's the other thing too. It's like you could obviously assume that market share could go down over time, not just up. But it seems to me more likely that over time, these larger players are probably going to continue to capture more and more market share, if anything. But anyway, moving on from the market share, there's also backlog. Now backlog as a portion of the of their sales. So like this is a percentage of sales backlogs. Now you can see that's one thing that's interesting to see, is the backlog jumped up in 2020, which makes sense. But then after 2020, things have kind of like started to trend downward. And for the larger players, they're actually below where they were prior to COVID, which is kind of interesting to see, and kind of seeing that start to play out as well as for KBH. And I'd be curious to see how that looks for Pulte and MVR whenever they report their 2024 numbers. But as a percentage of sales, it did vary pretty significantly, with some of these guys kind of closer to 25-30%, and then some of these guys closer to like 40 to 50% of their sales in backlog. And there's kind of two ways to think about backlog, I would say. I think you can kind of think of backlog as a positive thing or a negative thing. I think depending on your own taste, I guess. You could look at backlog as a positive thing, from the idea that like the more backlog you have, that's the more of your next year's sales you essentially already got locked down. And so in a sense, that makes it easier to know what those what the revenues are going to look like over time. It also gives you a further lead on what the price increases are going to be. But to a certain extent, it can also lock you in on those prices, so that can create some expense pressures as well. But then things can also be canceled too. Cancellation rates are a thing as well. So a further amount of backlog technically means a larger amount of sales that you have not yet delivered on, which could create problems as well. So it's like there's kind of multiple ways you can look at backlog, and you can kind of, like I said, it kind of comes down to your own perspective on what type of home builder you prefer. I personally actually like lower backlogs, I think. Obviously there's questions about being able to lock in those next year's sales. But I also like the idea of having the prices not necessarily locked in, because I look at prices as kind of like more constantly moving upward over time. And I'm concerned about cancellation rates. Cancellation rates is something that does worry me a lot. And I look at also that if you're in a larger market share player, then backlog I think is a little bit less of a problem as well. Like I said, I can understand seeing it both ways though. So that's kind of why I frame it that way. So personally, I prefer lower backlogs. And so it's nice to see that the larger players have the lower backlogs and that they're trending downward over time. So I do like to see that as well. Then coming over to those cancellation rates, I do actually have those cancellation rates as I was talking about here. For some reason, Lennar didn't report its regional cancellation rates here for 2019. So I don't, or it has a little bit of a gap in the data. But the nonetheless, we still have most of the data here. What are the cancellation rates? Like, are you asking like what they are as a thing, or like what they are as in here, this data right here? I'm not 100% sure what you mean by that. But yeah, so here are the cancellation rates. Cancellation rates, like what percentage of the new orders end up being canceled before they end up being delivered. And therefore, there ends up being some sort of partial construction that they have on hand, something that they have to sell off, or maybe potential full sale product that has to be sold off, or or potentially a renegotiation even of the pricing with a new customer potentially. You can see cancellation rates. Yeah, so you're just a little impatient waiting for the data. Like don't you worry, I come with the data. I come with it. But yeah, so you can see these vary as well pretty significantly. With, you can see like down here we have Pulte, MVR, and Lennar kind of down here, sub 20, kind of like in the 15 kind of range prior to COVID, dipping down a little bit and then kind of coming back up to kind of somewhere in the same range, a little bit higher it looks like for Lennar for the last couple of years slightly, although it came down in 2024, so it's kind of back around around that same average range. And then KBH is interesting to see this kind of strange variability. It looks like they were really working to improve their cancellation rates prior to COVID, and then they did go down pretty significantly during 2021 when there was like the big surge in demand. But then they bounced back up pretty significantly, though. Then they also came back down as well. So kind of interesting to see KBH's trajectory right there. DR Horton a little bit higher than Lennar, which is interesting because they've kind of been grouped together in a lot of these metrics. The two larger market share players tend to be kind of similar in a lot of ways. So seeing this big divergence between their cancellation rates is interesting, though it looks like they're coming a little bit closer in line more recently in the last couple of years. We'll have to see about that. Maybe DR Horton is improving, but maybe that starts to vary a little bit. Yeah, I don't know. I don't know what's up with KBH. It could be an issue, could be actually, hold on, we're gonna get to some data that might coincide with it, because that's one thing I was gonna say. It's like it somewhat comes down to the way the companies design their business model. It's like there's some, they change different details. Some of them prefer to have larger backlogs than others. Some prefer higher price ranges than lower price ranges, right? It's like you kind of like could tailor your business model a little bit. So like I was actually just hold on a minute a little bit, because I think there's some data that does potentially that KBH stands out, and not just on cancellation rates. They also stand out on oh wow, okay, never mind. I don't know why, but in my mind, for some reason, I thought it was KBH that had the really low supply one. So I was just about to say, if we switch over to the supply chart, I don't know why in my mind I could have sworn it was KBH that had the low supply. So never mind. I am not sure what's going on with KBH. Maybe you have to listen to their earnings calls to figure out what's going on with there. Maybe they had a changeover in management, and they've been slowly trying to improve ever since then. I don't know. I'd have to look closely to figure out what's going on with that. But coming over to supply, though, here we have the month's inventory supply number. That's what we have going on here. So yeah, I was wrong about it being KBH. It's MVR is the interesting one that stands out with just a significantly lower supply level relative to sales. This is months of supply, so it's relative to sales. Essentially, it's inventory turns, but turned into months. And so here we can see that the two larger players grouped well together again, a little bit better than the other two players, though not as good as MVR, which appears to just have something unique in their business model. They're probably specifically build to order. That's kind of what's going on here, is like MVR's got a build to order model that also has a relatively higher price range on it, which makes sense. So they're a little bit more of a luxury model, is what I would have to guess of MVR based off of that. Hoo-ha, my boy. Got a killer 10 bagger for me, huh? Reasonably well, reasonably well. Appreciate the thoughts. Throw it at me, I guess. I'm focusing on home builders right now, so I'm not going to probably go deep on it, but I'll maybe take a quick look at its chart or see what's going on with that. So anyway, moving on from supply, I also have the operating margins here. So here's their operating margin percentage for the segment. So it's a pre-tax operating margin that's gonna not be quite the same as like probably a proper operating margin, because it's not going to include some corporate and other costs as well. It's probably going to be slightly higher than whatever their like their overall operating margin is going to be. But either way, it's the segment operating margin. Here, interesting to see, KBH does stand out a little bit here though. So interesting. That might be a flow through potentially of the cancellations. Honestly, this might be the results of those cancellation rates. I'm not sure. Hard to say exactly. What was this? DR Horton's also kind of in line with KBH, just a little bit less volatile. But DR Horton has better operating margins, more in line with most of the rest of the group up here. Yeah, I'm the only one that covered Virtu, but I wasn't super bullish on it at the end of the day. I mean, I know I technically at the time of making that stream, I showed pretty good return potential on it, but I myself didn't trust it. It's like one of those things where it's like I didn't really trust it. It's like you tried to get me on that one, and hey, you snooze, you lose sometimes. But like, yeah, well, we bottom ticked it on the coverage, but you bottom ticked it on the purchase, right? That's the thing. It's like only one of us actually bought it. So, but good times, good times. We'll Virtu Financial. I've heard some. I've actually was hearing some talking heads give some pretty solid reasons to believe for why some of those smaller flow dynamic market makers could actually continue to do well over the next few years. So like increased volatility and expectations over the next couple years and stuff, tariff concerns, things like that. So I don't know. Maybe it's possible that they could be setting up for further growth. I don't know. I have no idea what the valuation looks like these days. I haven't looked at them in a long time, so I don't know. It's like one of those things where I'm just talking about their business. I have no idea what the stock situation looks like. But anyway, moving on from that though. So anyway, that's basically all the data for the East region. We got, like I said, average prices for the new orders, the new order share, the backlog against their backlog percentage against their total sales, cancellation rates, month supply, and operating margins. And so, like I said, that's for the East region. So then moving on, we can move on to the Western region. We have basically doing the same thing all for the West. Average prices here. Interesting to kind of see the slight differences between the regions. So like as I kind of said before here, DR Horton was the lower price range one, but there was a little bit of kind of like a wider spread, right? KBH was a little bit higher, but not too much higher. Then Lennar was kind of like in the middling, though they kind of dipped down a little bit in the most recent. And then also MVR and Pulte were just high on the higher price range up here. Switching over to the East, it's a little bit different. DR Horton is still kind of like the bargain seller over here. KBH over here, you'll notice that MVR is not in this region. We only have the 4 of them over here, by the way. But yeah, KBH kind of in the middling here. And then Lennar is kind of at least kind of in the same range as Pulte on the upper end as far for the West, at least for these ones. Obviously, if we could have picked some much higher upper end ones and even some lower end ones for both the regions technically, but these are just kind of the ones, like I said, I was focused on some of the larger players and then trying to get a mix between West and East. Jack asks about Apple. What about Apple? Did somebody say something about it, or are you asking something specific? Oh, I see your the AIG yeah, AGAJG chart looks like Apple basically. Interesting. I don't know. What is that? Oh, Arthur Gallagher. I was gonna say like I know that ticker, but I couldn't remember it. Yeah, that sort of makes sense. I mean, it's it's a super stable business model. Um, I haven't really looked at their I haven't looked at their finances too much, but it's a pretty stable business model. Actually, I might want to. I have no idea what the valuation looks like, but there's some reason for me to want to kind of throw them into some of my industry groupings to take a look at later. To be honest, I haven't thought about that company in a while. But anyway, moving on from the price ranges, then we also do have the market shares, which market shares also, like it says, like you can see pretty interesting kind of variation between the regions on of a lot of these different dynamics. Over here with KBH with the lower market share. Over here, KBH still pretty low market share, but Pulte actually has a little bit lower than them, but both higher. See, KBH had less than 1% or kind of around 1% at best over there. But in the West, KBH has close to 3% market share, which, like I said, that's actually one of the reasons I included them is because they had a little bit higher Western presence compared to some of the other ones. Um, price to sales ratio and AJG going parabolic over time. Oh, okay. Well, yikes. Good to know. Maybe I'll just ignore it altogether then. Yeah, I was gonna say like I was just like thinking about their business and I was like, oh, actually, I might want to look at them. I haven't thought about them in a long time, but like I said, not even thinking about valuation, just thinking about the business. But yeah, so interesting to kind of see just the little bit higher market shares for even the smaller of the larger players will be included here. But then DR Horton, pretty significant market share here. But then you'll notice Lennar actually has higher market share than DR Horton in the Western region. So like I said, like that's one of the reasons why like even though the Western versus East region grouping was kind of a little bit weird and kind of created a much larger Eastern region, I was kind of fine with it because the West is different in a lot of ways. One, it has a larger population growth, also has some better economic dynamics in some regards. See back my stream from a couple weeks ago where I go into all that detail. Having a little bit more focus on the West and being in a company that's a little more focused on the West, I think is actually pretty good. Like I said, my model also assumes that the market share basically stays the same over time. So like in my Lennar valuation, I'm assuming in 2034 they have 9.2 market share. Maybe they have 9.2%, maybe they have 8.2%, but maybe they have 10%. I have no idea. I'm just assuming the market shares remain static over time when you can see a pretty consistent uptrend. That's consistent with the uptrend that we kind of saw in the East, though, like I said, the smaller players have a little bit of a different dynamic going on. The DR Horton and Lennar dynamic is sort of the same. It's just one is a little bit larger than the other. That is to say that they're both trending upward. And then pretty much all of the upward trend in the larger amount as a group is come pretty much on the backs of those two larger players. Here you can see KBH. It looks like they've gone up a little bit over time, but not a ton. And then Pulte looks like it's basically about the same. So it's like, yeah, overall, Lennar and DR Horton, whatever they're doing, has caused them to just grow in market share in East West altogether. It's just one is focused more on the East, one's more focused on the West. So moving on to backlog, kind of similar dynamics as we saw in the East. Here we have the East, here we have the West. You can see it's actually pretty similar charts all in together. So kind of similar commentary, I would say, as a whole, which is to say that I like to see the downward trend. I personally like to see not a huge percentage of backlog. You don't want to have zero backlog, but I don't know that I would want to have 50% backlog. 20% backlog, 15 to 25% backlog. That sounds pretty nice to me, but yeah, getting up to like 50% backlog, that sounds like you're just asking for cancellations. My perspective on it, like I said, I can understand kind of both perspectives on backlog, so I don't really think of that as like some like, oh, if you look at it the other way, you're an idiot kind of perspective. I think it's all comes down to your kind of preferences about the type of risk you'd like to take on. But I mean, coming back over like for example the cancellation rates versus the backlogs, like as we saw before, KBH has high cancellation rates and high backlogs. And that's like a recipe for disaster in my mindset. So looking at the same thing with the West, we have the Western backlogs. KVH has higher backlogs. Lennar has lower backlogs. Cancellation rates. What do we got going on here? Same thing I said with Lennar before, that for some reason they didn't report their cancellation rates a little bit in there. The cancellation rates are a little bit more grouped up in the West. I will point out that they are also a little bit lower or well, I would say like the highest ones are a little bit lower. See, like the highest ones over in the East, we had kind of like up over 20s, and then kind of up over 30s at the peak points. Whereas in the West, we reached 30 for Pulte in 2022, but in general, most of them stay at like 20% or lower over here. So it's definitely kind of a little bit of lower cancellations, it looks like, in general in the West, which I think speaks to the higher demand. Like I said, higher population growth, higher demand, a lot less of like kind of stagnant populations that have been there for many generations, like up in the Northeast and the Midwest and places like that, which is, by the way, reasons why like I'm just less enthused by those regions is a lot of the demographic dynamics and stuff. It's like I like the idea of home building in a place where people are moving to and people are having lots of babies. You know, like those are the places where you want to be building homes. So in general, the West is good for that, like lower cancellation rates across the board. Yes, we had a spike up in 2022, but in general, lower cancellation rates across the board. And Lennar has lower ones in general as well across most of the years. Then moving on from that, we also got the months of supply. Months of supply, kind of comparing between the two is interesting to see as well. That I would say like the average over in the East is kind of like 8 to 9, whereas like the average in the West is kind of more like 10. So in general, there is actually more supply, more inventory over in the West. So that's kind of like the one kind of negative aspect I would say about the West right now, is that there technically is a larger amount of supply, and this is month supply, so it's already scaled to the sales levels. Now I would say, as I talked about this before when we were in the regional data that I showed a couple weeks ago, is that that's true, that technically there's high levels of supply in the West, which is a concern, but that doesn't take into account how low the current amount of sales is. So it's like if we get some mean reversion in the sales levels for the West, then that supply level actually kind of normalizes a little bit. It's not low, but it kind of normalizes a bit. So that's why it's like I'm not actually super concerned about the supply levels in the West, but it is worth noting that it is a bit higher, a bit higher. Lennar has lower relative to its peers in that regard. So you can see is like Lennar is Lennar is kind of middle of the pack in a lot of the Eastern aspects, but once we switched over to the Western stuff, Lennar ends up being kind of the better of the pack in most of these details. So that's in which, like I said, is like I think the West is one of the better, has better demographic dynamics. It's definitely like the better region to be in. So it's just like a lot of stuff that gives me reasons to be bullish on Lennar. And a lot of those details, like I said, aren't really even baked into my valuation either. So a lot of this this industry and kind of regional dynamic stuff that I think spells strong tailwinds for Lennar is going to be icing on the cake. So that's pretty great to see too. And then also, like I said, like, I'm not going to get into all the details of it now. I plan to do like a video on my Lennar valuation, but the valuation that I show also over here of Lennar also has an incredibly conservative next year or two. I'm basically assuming that like the analysts are like way wrong on their cash flow estimates for the next 2 years, and that they're going to get like half as much cash flow is being projected there too. So I'm being super conservative, I think, in the short run, to essentially kind of like also add a little bit of a buffer on profitability. I'm kind of calling it my supply shock slash tariff shock conservativeness. That's kind of like what I'm treating it as. I'm like, in case something crazy causes some big hits to profitability for one reason or another in home builders in the next 2 years, whether it's because of oversupply levels over the last couple of years, or it's because tariffs cause some sort of hit to profitability in some way, or whatever, whatever it is, we basically just like through the kitchen sink at the profitability for the next 2 years a little bit. But like I said, I'll cover that in my valuation video whenever I get around to it. So anyway, moving on from supply, then we also have the operating margins. Operating margins, kind of similar to with the Eastern ones. Honestly, they're kind of are pretty well grouped together. there's not a lot of outlier there. In the East, we at least had KBH to kind of pick on. They were really kind of sticking out a little bit as being lower operating margins, but in the West, they're actually pretty well grouped together. Yeah, there was a little bit more variability back here, but things are pretty well grouped in kind of an interesting way in that regard. So that's kind of all the charts I had put together of all this data. Like I says, like I could have made more. Technically, I have a lot more data put together, but I also didn't want to kind of cover a lot of the same type of information. Like a lot of the other information types I have is like a lot of the same information, but on new orders versus starts versus delivery. So there's like this kind of like the different stages of production, and you can kind of look at like what are the prices at the different stages of production, and what is the supplies at the different stages, and yeah. So it's like I sort of have like the same data 2 or 3 times over. So I kind of just showed one variant of each of it. But you can, I think I've kind of painted the picture both in this stream and in the last stream I did 2 weeks ago about like a lot of reasons why I'm bullish on home building. It's like home building in general. I think I painted a good picture of with all the dynamics, and I think I also quelled a lot of the concerns people have about home building in general in this stream from 2 weeks ago. And then also in this stream covering this data, I think I think painted a good picture of why I'm bullish on Lennar in particular and on the Western region in particular in the context of Lennar. So yeah, like I said, I think there's a lot of reason to be bullish on it. Like I said, when I first started looking at this one and seeing even my targeting system was telling me I should be putting a lot of capital into it, I've been hesitant just because home building is such a volatile industry with a lot of cyclicality to it, and I've actually also been burned on home builders in the past as well. So it's just one of those things where I've looked at it and just been like, I don't know. Am I setting myself up to be burned again? And I, even like I said, I kind of started to dip my toes into Lennar, and I was looking at it and I was telling myself, I was basically like, even if I'm wrong on the timing, it's like even if like the next 2 years are like a total disaster zone for home builders, if ITB just like craters over the next 2 years, in my mindset, like 10 years from now, and 10 years from now, well, I mean, I don't know where ITB will be because it's an index that includes a lot of players, but 10 years from now, I just don't see how Lennar isn't like crushing it. But yeah, I don't know. It's a lot of, like I said, a lot of stuff that goes into it, but I'm just very bullish on it. Jack, talk some miners. Hey, that was definitely what was coming next. Yeah. We're rolling up into it. I will answer Mr. Beast's question though, because I saw Mr. Beast popped in. What's up, man? What about Mastercraft? I don't have a ton of things to say about Mastercraft today. I mean, I'm still holding it. Still see upside on it. Was up on it a little bit and then was down on it again. It's kind of been zigzagging a little bit. I'm also kind of keeping an eye out for earnings on that one. They tend to have later earnings, so readjusted my valuations a little bit. By the way, the valuation you see over here is, I mean, a lot of the valuations I put on my own things tend to be conservative for one reason or another. So it's like here it doesn't show a ton of upside, but I will say that this basically has like very little growth in it, and also has probably overly conservative assumptions about cash flows in the very near term. So it's like, it's one of those ones where it's like this valuation is probably easy to outperform, honestly. I'm just kind of keeping it that way until more earnings come in, and I'll probably relook at the model, because that one also, by the way, fits also into the camp of more of just a straight up valuation play. It doesn't really fit into like an industry that I have like a whole lot of bullishness on all of the macro dynamics of. So it's like Mastercraft, it's not heavily in my thoughts, basically, is kind of the way I would put it. It's like it's kind of, we're just in waiting on Mastercraft. The valuation will play itself out over time. I'm looking to see more information about the new management. I'm really looking forward to the new proxy statement whenever that comes out. Well, I mean, they report their earnings more like mid-year, so it's going to be probably a while for the proxy statement on that. But I am looking to kind of look into their new management a little bit more, because like that's one of the other things about Mastercraft is that they turned over their management not too long after I started my position, which kind of threw some chaos into my confidence about, like, whatever the strategy was. So it's like we'll see what the new management says and thinks about what the strategy is going to be going forward, and that kind of can change things a little bit. So we're kind of just in waiting on Mastercraft for now. So Len is the best buy. It's definitely one of the better buys. That's for sure. In my opinion, for sure. I pretty significant upside. I mean, there's other ones that are pretty significant upside, like InMode. I still think has pretty significant upside. It's like InMode, Lennar, FG. Those are the highest upside ones. Oh, Silvercorp. Those are the highest upside ones in my portfolio. After that, I've got Skyworks, just gold, just outright gold. I'm, just go buy some gold, guys. I don't know what to tell you. Go buy some gold. You probably should have bought some gold when I was telling you to buy gold years ago. I don't know what to tell you. Buy some gold. Or buy some gold miners if you want to be less. Yeah, right. Okay, Fear Shift. Yeah, I mean, hey, Fear Shift's a funny guy, and obviously he's a salesman. But he's wrong more than twice a day. Like they say broken clock's wrong twice a day or whatever. He's right more often than that, but he's wrong a lot too. He predicts more recessions than happens, that's for sure. But is his general perspective on what gold is probably accurate? I would say so. I mean, that's the thing. Like, I'm a gold bug, so you can say what you will about it. I think I have a realistic perspective on my gold buggishness. But I don't think, but point is, my perspective of gold is money on a global scale from a central bank perspective. So, and that's just basically never really going to change. But to be honest, it's just more of an asset than like a liquid transfer item. That's the difference. So, full portfolio. Yeah, for sure. Go all in on digital gold. Yeah, and I mean, I don't want to get into the gold versus Bitcoin thing too, but like they're just fundamentally not the same thing either. It's like, do they behave similarly under certain dynamics? Yes, but nobody's looking for their Bitcoin for industrial or jewelry purposes. That's the main difference there. But yeah. So anyway, let's get into some miners though. Let's talk about some miners. Technically, I was also kind of planning. Well, okay, actually, hold on. Let's talk a little bit about annuities because I have a lot less I want to say about annuities. I was just gonna give some quick comments about that. Which is to say, because like I said, I'm planning to do more research on FG once the 10K comes out. I'm kind of working to build up that, but I just kind of want to give at least a quick update on the industry to kind of point out my general bullishness on the annuity space and where that's going. So here is total annuity sales in billions for the last few years going back to 2019. At least it gives us an idea what it was like prior to the interest rates starting to come up, which is the important part of the chart. So here, huge jump up. What happened in 2022? Huge jump up in interest rates. Indexed annuities is going to be in particular the group that I'm most focused on. That's the group that FG sells. So they sell primarily in here, which it is worth noting it's a much smaller of the jump up, but still a jump up. So I'll jump up in sales and fixed index annuity sales in general. And this is only going to 2022 because so this is a little bit older. So then I kind of brought this, which is more recent, the actual sales from the last few quarters. Then we have 2023. So fixed index annuities. It's the same category for 2023, 95, 96 billion, right? So we went 55, 56 billion, 63, 64 billion, 79 billion, 96 billion. Full year 2024, 126 billion. You guys seeing the upward trend here? Yeah. And I would point out that in 2024 we didn't really get any increases in interest rates, right? So yes, the increase kind of started with the increase in interest rates, but I'd point out that was more like a catalyst for the change because there was already going to be significant demand for these types of fixed income products due to a lot of the demographic dynamics that we were talking about earlier. So it's that's why, for example, you'll see that even though interest rates actually moderated in 2024, we still see significant growth in the category because, to be honest, it was more of a catalyst for change than it was a specific macro dynamic. And FG can, for the record, because of the way they structure their products, they're actually well positioned to do well in rising and lowering interest rate dynamics. They kind of have different profitability profiles under both of those dynamics. So anyway, that's just kind of my quick update on the fixed index annuity industry, which is to say that as of even the most recent quarter, It's just an upward trajectory for the business. And then there's the other portion of FG's business, which is the part of the business that I'm kind of working to get more detail on and a better understanding on to model better, which is their pension risk transfer business, which is a smaller portion of their business, but over time is probably going to become a bigger portion of their business. And then over time, as like all of the boomers have fully aged into retirement, and as the growth in the fixed index annuity retirement product space has kind of like leveled off, um, that's the next phase of the growth for FG will largely be coming from the pension risk transfer space, and it'll have legs to grow for probably another decade beyond that. So it's like basically this is like the next growth avenue for them, so to speak. And I mean, it's next. They're already in the space and already growing within it. So the point is, like I said, it should become a much larger portion of their business over time. It's like they're gonna be moving more towards these kind of institutional sales. But I just kind of wanted to show that too. It's like I've been doing research in that, just to give you an idea of like the trended trajectory for that business as well. Here we have like the number of transactions in the lighter gray, as well as the actual dollar value in billions over the last like decade or so up to 2022. I didn't get like the most recent numbers, like a chart for this for 2024. I've seen them, so like I know that it's in trend. The chart is in 10, but I didn't find like a good chart to show you guys that. But either way, the point is, you can see this is upward trend over time, and this trend was well before the interest rate dynamics changed, because this doesn't really have to do with that. This just purely has to do with the demographic dynamics, but also the changes in corporate structure dynamics that have been going on for many decades, which is to say that there's a lot of companies that have defined benefit pension systems that they would really rather not have on their books anymore, and would really not have those contingent liabilities for anymore, because they're like some industrial company or something, or some telecom company, and they don't really want to be managing a pension fund. So the point is, like, it creates a lot of opportunity. And you can see like growth in just the number of transactions, but also the growth in the dollar volume itself, excepting 2012, where there was like a really large, a really huge pension plan with AT&T, I'm pretty sure they had like a huge transaction that year, and that's part of the reason there was like a huge one in 2012 that didn't get surpassed until 2021. But anyway, so boys, that's just my quick update on those two aspects of FG's business. Because yeah, it's like the annuity and institutional annuity sales is kind of the third industry I'm focused on. It's like there's home builders, there's annuity and institutional insurance products, and then there's gold. Those are like the three industries that I'm like hell bent bullish on to the ultra max. Those are my top plays. There's a lot of ways you can play those industries. There's multiple companies within those industries, but those are the things. So anyway, yeah, let's talk about some gold. Let's talk about some gold. I've been a little bit more scattershot the stuff I'm going to talk about gold, because like I said, I did a lot of work over the weekend. I'm kind of still working to do work on that. Let me come back over to the here. So like I've been doing a lot of updates to these valuations as well. So kind of like I was saying with the home builders, there was only like certain ones that I would say I had like higher confidence in the value as I show it. And so that's kind of true here, where I would say it's like I have higher confidence in these valuations, I would say. Yeah. Yeah. These are the ones that I've either modeled out all of their mines individually, or they're a royalty company and is a little bit easier to model. So it's like that's where I'm at with that. Which, like I kind of mentioned it earlier, I kind of did the math on it, and I was actually kind of impressed with it. It's like all in for all these companies, if I put them all together, this makes up like over 2% of the world's gold production, which doesn't sound like a lot, but it is. Actually, no, that's a significant understatement, because that's not even including Barrick. Actually, I'm not even sure what it is, what it is. But the point is like put a decent dent in modeling out a decent portion of the world's gold production. And then going beyond that, I also was trying to look at like total reserves, because like I've been looking at gold miners basically the whole time I've been an individual stock investor. I started with a super rudimentary approach with looking at stocks as I did with all stocks. But the point is like I've stayed with that industry the whole time. So like I've definitely learned a lot over the years, and kind of grown my sophistication, I'd say, at understanding the industry as a whole. But the point is like one of the reasons I'm so bullish on gold has to do with demand dynamics, uh, which is to say like my belief about monetary debasement, my belief about the growth in the money supply, and my belief that hard assets to move up with the growth in money supply, and gold in particular is one that people kind of work well in line with that. And then there's also central bank policies and behaviors over time. You can kind of watch and study. You can look and see like what ratios central banks have held over time, over many decades, over like 100 years. You can do this. You can look over a very long period of time, and it's pretty consistent. And then also you can look at even like recent trend stuff, like here the gold.org, their gold hub, which this website, the World Gold Council, is one of the best resources to get lots of information about gold. Free resources, by the way. You just have to make an account with them, but it's free. You can get tons of high quality data about gold markets and stuff. But they do this survey every year with central banks and ask them what is your expectations about all sorts of things, about your own holdings of gold, other central bank holdings of gold. What do you expect to happen? How many dollars do you expect to hold over time? All various questions like that. But the trends are pretty positive for gold in those regards too. And the reason why it's worth noting about central banks is because they tend to be one of the largest marginal buyers in the market. So that's why it's worth paying attention to what central banks are doing, because they tend to be one of the bigger players that's going to cause a significant shift at the next dollar level. Like if you're looking at, like, for example, the demand, the yearly demand levels. Well, this is quarterly. Let's look annually. They're not necessarily the largest portion. Like central banks are only down here, this kind of like the smaller portion down here, but they're the portion that has pretty significant variability on any given year. Like you can see pretty significant swings from one year to the next. Whereas there is movements in the other groups as well, but they tend to be a little bit more steady. Like it looks more volatile when you kind of get down to like this, because that kind of the total left hand scale went from 5,000 tons down to 3,000 tons. So now that's like 40% of the chart that it's increased the variability on. But here you can see, like, other than 2020, which was going to be a fluke there, we had actually 2024 looks like it was the lowest level, about 2,000 tons in 2024 versus about 2,700 tons in 2013. Then the technology levels have been coming down over time, but you can see don't shift too much from one year to the next. It's coming down over time, by the way, because the price is going up. As the price goes up, it incentivizes people in technology to find alternative uses, or alternative metals, or alternative things to use instead of gold, because the price of gold has gotten so expensive. That's actually one of the specific reasons you see this trend. Jewelry fabrication, you don't really see that trend in, because people like gold for jewelry because it's valuable. So there's sort of like a circular relationship in terms of like the value of gold and its desire for jewelry. And then investment, it can vary quite a lot. But it's not necessarily a huge portion of it. You can see it's one of the smaller slices. Technology is technically like the smaller slice, but central banks, you can see, have also started to really pick up pretty significant pace over the last several years. They went from pretty small amounts up to pretty moderate levels here. Then it came down a little bit, 2016, 2017, came down 2020, 2021, and then 2022, 23, and 24, we've had record levels from central banks. And that's actually one of the big factors that has caused the price push upward, is this constant demand from central banks. And then, like I said, according to their own surveys, they appear to believe that they're going to continue doing so going forward. So, like I said, a lot of aspects of it. That's more focusing on the demand aspect of it. Then there's the supply, which is, I would say, causing prices to go up pretty significantly for those reasons as well. Mostly focusing on the mine production aspect, because there's going to be producer hedging, which is kind of an almost non-existent portion of it. Recycled gold is a significant portion, which is kind of a somewhat steady amount, and in some ways, as gold prices go up, that incentivizes people to recycle gold more. but it doesn't tend to necessarily move up as a percentage too much. Overall, mine production is kind of the thing that we also want to focus on when we're talking about supply. And mine production has peaked at 2018 and actually has not come back up to those peak levels yet. Or actually, did it in the most recent year finally peak again? Oh, actually, it looks like it did. It did. Okay, I thought it was still below that peak level, but it looks like it's basically still at it at exactly that peak level we reached in 2018 or so, give or take. So like my production itself is moving up very, very slowly over time, and it's become more and more difficult for the supply to increase over time, partially because of where gold is. If gold tends to be very concentrated in specific in the larger deposits is tends to be the places where you have a higher chance of finding more gold again, and the larger deposits tends to be in well less secure districts. Like for example, a lot of the larger deposits are in less desirable jurisdictions of Africa. Is where a lot of it is. Wait a minute. Let me pull. I was like, here we have here's like the current global mine production. China and Russia being somewhat exempted because they kind of have not exempt. I mean, obviously they have pretty major production, but like they have their production. A lot of it is actually very state run. Like they actually have very significant state run operations for gold production. Large corporate run operations as well. But the point is, a huge amount of that production is very specifically filling the coffers of the state relative to like a lot of the other production. But like a lot of the Ghanaian and Mali, Africa is some of the larger deposits that have not been developed yet. And then some of the other deposits that have not been developed have also been in Canada. And coming back over to this chart here, like this chart is like one of the better charts I've found that shows like the larger deposits that still exists in general, and the companies that are still working on that. So like that's one of the things that I also was trying to focus on, is not just some of the smaller players that might have some potential value on their current operations, but like what are some of the better growing operations potentially over time. And like because like some of the companies that I found reasonable value in these top four that kind of have positive value to them, they all kind of have like different dynamics to them. So like for example, Silver Corp is more of like a legacy silver producer that has been working to acquire its way into the gold markets, and it has recently acquired a significant gold operation that it's working to develop. And so like it's currently developing gold operations and is a legacy silver operation. New Gold is kind of like a legacy gold operation that is working to potentially reclaim and find new operations in its immediate area, but it actually potentially does have pretty significant limits on what it's going to be able to find in those areas. So this one potentially has like a much shorter lifespan to its operations, whereas like also then Equinox and Orla, they both also have potential growing operations through either acquisition or the growth of their own internal operations. I have these different spreadsheets for each of them, where it kind of, like I said, I broke down their mines separately. So like Silver Corp, I have their Chinese mines and their South American mines that they're working to develop model separately. And then New Gold, they have both their New Afton and Rainy River um, uh, Canadian operations. Then Equinox, they actually had, what was it, 8 different operations I had here. Let's see, Arizona 1, Castle Mountain, that's 2, Mesquite 3, Los Filos 4, RDM 5, Fazenda 6, St. Louis 7, Greenstone 8. So okay, yeah. So this one had 8 different mining operations. Some of them were in Mexico, some of them in Canada, and then one of them was also Bolivia, I believe, was one that was working to open up as well. And then Orla has 2 different operations, though they're working to potentially start up a third operation. So it's like, yeah, a whole lot of different work. But for each of these different mines, what I do is I get their reserve numbers. You can find their reserve numbers as well as their resource numbers, and you kind of understand like the resources is basically the amount of the amount of the resource doesn't have to be gold. It can be gold, silver, copper, whatever it happens to be. Whatever the amount of the resource that is not yet economically feasible, or is not there hasn't been significant enough studies to necessarily understand just how much of it they're going to be pulled out of the ground. But they basically know that there's gold there, right? It's like it's one of those things where it's like they're not sure just how profitable it's going to be, or they're not even sure how easy it is it's going to be get out of the ground, but they're pretty sure that there is going to be some gold there. type thing. So like they usually have measurements of these types of numbers, which they refer to as resources, either measured or indicated. Then they also have reserves, which is which they also they either categorize as either proven or probable, which is gold that they're like, no, we've measured it. We're not, we don't know exactly how much money we're going to make from it, but we have a pretty fine idea of what it's going to cost to pull it out of the ground, and so we have a pretty decent idea of just how profitable the venture is going to be there. So like all mining companies report these numbers to you, and you can take their reserve numbers as well as whatever their current production numbers are, and you can essentially divide between the two to say, okay, how many years of mine life do we have left? So I do that for each of these mining operations, and then you can look at their resource numbers, and if you can get a record of how the reserve numbers have changed over time, you can kind of model out and say, okay, just how good are they at replenishing their reserves over time? Like as does their resources move down over time while their reserves are moving up over time, which kind of shows that they've essentially converted their resources into reserves, or do their reserves go up over time while the resources go up over time, which shows that like they are both replenishing the reserves while also still discovering more resources. Or maybe they're both moving down over time, and then they're essentially converting the resources to reserves while also still producing out of those reserves. So you can kind of like get different dynamics by like taking a look at the production of a company over the course of a few years, as well as how their resources and reserves have evolved over those few years, to get an idea of essentially like just how many years of production does this mine have left, and how likely are they to be able to extend that production life over time. And then obviously like the actual production numbers themselves like can vary a lot too. It's like they might have planned to do 100,000 ounces a year, and maybe they end up doing 150,000 ounces a year, or maybe they only do 75,000 ounces a year, right? So it's like you kind of want to take that into account too. Is like that kind of shows like their own ability to essentially achieve what they said they were going to do. And sometimes they change their plans over time too, but that affects things. It's like if you pull the gold out of the ground sooner, that's going to give you a shorter life, a life of your mine, but it's also going to get you the money faster, which means that theoretically it's gonna be more profitable because time value of money. So that means bird in the hand better than two in the bush type thing. So it's like if you have slower production, they're slower to get the production going, you're gonna have a longer life of mine, but then that means it's gonna take longer for it to get you. So time value of money, it's gonna be less valuable to you. But there is also some give and take to even just thinking about it in those terms, because the longer you are operating a mine, even if the mine is like going down over time, like the reserves are disappearing and you're not really replenishing over time, the longer you operate the mine, technically that gives you a longer period of time to make a new discovery. So if a company is reasonably good at making discoveries in gold, like if they've shown success in this gold discovery in the past, then technically slowing down your production to extend the mine life could actually be the more beneficial thing, because even though the time value of the current mine life is lower because you're extending the production out over a longer period of time, you're increasing the odds that you're going to make a new discovery and therefore increase the value of the mine. Like I said, like you kind of have to take these things into account. One thing I will say is like this is something I find is just true when thinking about mines, and really it's just true about thinking about natural resources in general, or at least all ground-based natural resources. So it's true of oil, true of natural gas, true of gold, silver, copper, all of those. I wouldn't say it's not really true of a crop, so it doesn't really apply to all natural resources, but like in the ground based resources, like for most companies, we think of them as a like the way you think about the model of the cash flow is like you have a growing cash flow stream over a certain projected period of time, and then that gets you to your terminal value, where you then have a growing perpetuity, and then that's how we model it out, right? We have the 10 like a 5 to 10 year growth period where we're growing our cash flows over that period of time, and then that gets us to our terminal year where we say, okay, well, you're going to grow at the same rate forever, and then we're going to just expect the same rate of return forever, and that gets us our terminal value, which then gets us our discounted cash flow model, right? Like this is how a discounted cash flow model is set up, is that you have this two-stage growing section and then a growing perpetuity together. When you're thinking about a natural resource company, I think it helps to think of it differently. Rather than have a growing projected period and then a growing perpetuity, you have a growing projected period attached to a call option. That's how you think the better way to think about it. Because with a mine, you do have a finite life, right? Like rather than with a company where you can say, oh, well, I'm just going to keep selling this product forever. With a mine, you have a certain amount of life. So it's like if you start a mine and there's a 20-year life, then you have 20 years attached to it. But you do have this call option on the end of that where there's this potential that you could find a new discovery or you could potentially extend that mine, right? And in order to make that mine, you would have to pay capital in order to develop that mine, which would be like essentially the strike price of the call option. And then the maturity of the call option would basically be the mine life of your current mine. So like I think it helps conceptually to think about mines in this way, where you're like, okay, I have a finite life, growing perpetuity, but it's a finite life. And then attached to the end of that, I have this call option where it's like there's this potential that it could become more value, but it also could potentially just end right there, right? So it's like I think it kind of helps to think about that in that sense, and that helps to kind of understand like how resources and reserves relate to the productions. Like the production and the reserves tell you how long of a period you have on your current cash flows, so to speak, and then the relationship between the resources and the reserves and the company's own historic success in that regard gives you an idea of just how valuable that call option is. And you can literally use an option pricing model to value it in this sense. I don't literally do it that way myself. I just like to think about it conceptually in that way. I just use like a terminal multiple like anything else. But you'll find that mining companies tend to have very, very low terminal multiples. They tend to be trading at very, very low single digit multiples. And this is one of the reasons why. It's because they do have a limited amount of life attached to them under most circumstances. Like I said, there's different circumstances and different things going on at that. So anyway, moving on from that though, like I said, like we have the resources, the reserves, and then the production. But then beyond that, companies also report to you something called an AISC, an all-in sustaining cost. This measure is a good way to think about. It's similar to an operating margin. It's not exactly an operating margin, but it's kind of similar to an operating margin. It's a non-GAAP measure, first of all. So it's like every company that reports an AISC, they'll usually report to you an AISC reconciliation table, so you can literally see like the specific things that they included in that measure. But it's very similar to an operating margin on a per weight basis. So it's like if you have an like for example an AISC of 798 for gold, then that's basically saying that like to produce an ounce of gold at this mine, it's going to cost me just under $800 or so for that, which means theoretically that like if gold's trading at $2,000 an ounce, then that means you're going to have about $1,200 of an operating margin on that ounce. Like I said, those costs usually includes a decent amount of capital expenditure. So that's why I say it's not exactly an operating margin. It's just kind of similar to an operating margin because they're usually including certain operating costs and certain capital costs because there is a certain amount of capital expenditures that are required in order to sustain the life of the mine. So that's kind of why they call it a sustaining cost because it's specifically including some capital expenditure measures. But then most companies will also give you what those capital expenditures are, and then they'll break out their capital expenditures into maintenance capital expenditures or sustaining capital expenditures versus growth capital expenditures. And to be honest, I kind of wish most companies did this. There are some other industries where you'll find companies breaking out their growth capex versus their maintenance capex. But in general, most companies don't break it out that way. They just kind of leave you to find some way of estimating that, or maybe they'll give some comments in their call about that or guidance about that, or they'll maybe give you some indirect way of estimating that. But I like it when a company literally tells you what those numbers are regularly. But anyway, so the point is like if you use all the metrics and put it all together, you can essentially kind of model out the cash flows for the specific mine. And a lot of mining companies will give you the fine enough details on all of their mines that you can essentially do this from the ground up for all of their mines. So I've kind of done that, like I said, for all these companies. I've mined out like 15 mines yesterday. It was basically how I spent my whole day yesterday. It was a lot of work, but definitely worthwhile, I found, because while it it lowered my estimate of some values on some companies and raised it on some others. But what it definitely did is gave me a lot more confidence in like the super specifics of some of these. And there's some conservatism attached to some of these values as well in some regards. So like that's where I'm at with that. Because like for example, I currently already have a position in Silver Corp. I have the position in them for some time. I have a position in New Gold. I've actually had multiple positions in them over time. I just started a position in Orla, and now I kind of want to start a position in Equinox tomorrow potentially. Which that means I'll have 4 different gold miners in my portfolio, and then I'll also have a gold ETF. So you might be like, "Wow, okay, you're really going all in on gold." Though, like I said, like I'll also only have like it'll be like 15 to 20% in total exposure. So it's like I think on a if you think of it as a total group, I'm reasonably fine with that. And I'm just I I just am bullish. I am just bullish. So those gold prices, it's like in my opinion, like I started off talking about it, the potential of like, yeah, gold prices could come back down, but it all comes down to like how far do you think they come back down to? For how long do you think they stay down there? And where do you think the long term trajectory for them is? Because, in my opinion, the long term trajectory for them is probably upward. But it's worth noting that like these valuations are assuming essentially the current gold price 10 years from now. We're kind of assuming that whatever they're like, I make a projection for where their revenues are supposed to be, like I said, on kind of a production basis of thinking about the life of the mine. And so I'm kind of like really just thinking about like what is their average production ought to be over the life of the mine, and then making a projection based off that. But the gold price that I attach to it, like these are the gold prices that I'm attached to it. I have a bear case gold price of 2,400, a base case of 2,900, and a bull case of 3,500. But that's in 2034. 2034. So the average gold price that I'm attaching to it 10 years from now is basically the same price as it is right now. It's worth noting. And then I kind of have like a somewhat smooth upward move on my revenue curves for those valuations to that revenue level. So it's essentially assuming that there is some sort of pullback in gold. I don't know. It doesn't really explicitly assume what that price is, but it kind of in some way assumes that the price does this over time, right? Like it comes down a bit and then it comes back up to that same price over the course of a 10-year period. Like that's essentially what I'm assuming in the valuation implicitly. And even then I get these valuations, which some people might say that's bullish because some people might think that gold's going to crash and then it's going to stay down there for a long time or something, but like if you even think that like today's gold price is reasonable, then these valuations are reasonable. That's my point. It's like if you think that long term today's gold price is a reasonable long term gold price, then these valuations are reasonable. And I personally think that bullish price I attached, 3,500 was it? I mean I think we could literally be at 3,500 by the end of this year. So it's worth noting that like I've attached bear, base, and bull gold prices to my gold valuations for gold miners for years, and gold has consistently beat whatever price I have attached to these valuations. So it's just one of those things where it's like I put a price that I think is reasonable. Some people think I'm being bullish, and then it turns out that I'm actually being bearish, like every time. So I'm not saying that's what's happening this time too, but I don't know. I think I have a history of actually being reasonably conservative on gold prices, despite the fact that I would describe myself as a gold bull, and I would say that I myself am pretty bullish on it, and I have always been. So it's one of those things where like, yeah, I have a bias for the space, kind of, I guess. But am I biased or am I just right? I don't know. You tell me. You tell me. Like I've been bullish on gold since it was 1,200 an ounce. That's all I'll say. And we're more than double that now. We're on our way to triple that. The barbarous relic that isn't supposed to be able to compete with the S&P 500 that did basically the same return last year. So yeah. So that's that. I didn't want to get into the finer details of like all of these companies because, like I said, it's like it's a whole lot of valuation to look at. So I kind of just wanted to like paint that general picture of how I do these mine-based valuations. all these companies report these numbers, these figures in their annual information forms and in their management discussion and analysis forms. Or sometimes on their sites they have like separate pages where they'll list their reserves. There was one other company I did want to talk about in regards to gold. One that I'm very interested in. I haven't really done a proper valuation for it yet, because it's not one you can really do a traditional valuation on. Let's come back over to this thing. This zoom in a little bit. Get the thing. Right. So it's like I was talking about this, like these larger deposits. These are larger mine deposit projects that exist around the globe, and the companies that have access to them. Um, these largest ones up here, this number 1 and number 3 project, KSM, are both owned by Seabridge Gold, which has been on my radar for a while. I'd heard some big like mining experts in the gold space that are like well renowned talking about this company a few times, and so I'd kind of been on my radar a little bit. And then it had been on my radar. I think even when I was doing some of those qualitative screens, like it came across my radar a little bit then too. But then I didn't end up doing a close look of it because when I ended up going to try um, to go see if I wanted to do a valuation of it, I remember being really put off. Show you. I remember being really put off because I found this. It's this company with no revenues, just expenses and losses, negative operating cash flows and capital expenditures and debt issuance and common stock issuance, dilution, not a ton of cash on hand, some debt. Yeah. So yeah, no, like it really kind of put me off when I found all that, right? So I kind of just like I was like, oh, okay, I don't know, I'm not sure what these guys are talking about. I was like, but like I said, like one of the first areas that first put this company on my radar was some like mining experts, like geological experts, like some people who like really know the field. When they're talking about the companies that they like, they brought this company up, and so it's one of those things where I was like, okay, well, they understand this stuff better than I do, so like they're looking at it from a different perspective, and so like yeah, maybe they're not looking at like a traditional DCF way, but they see the value because they're like, oh, there's a lot of opportunity here. But then, like I said, I was looking into I was looking into different mine and deposit sizes when I was doing this kind of like mine based valuation approach. And then I came across this chart and I saw this one here, and it just reminded me of that. And I was just like, huh, that company has some of the single largest gold deposits projects that exist, of like close to 90 million ounces, which for the record, like I was talking about being happy about being able to model like 2% of the annual gold production, right? Now, 90 million ounces is 2% of the entire gold supply, the above ground supply. So that's a huge amount of production. It's a huge amount. I mean, obviously you don't produce it in 1 year. I don't know how much of this you would produce on an annual basis necessarily. But the point is like I was just like, wow, that's a gigantic deposit. Which the KSM project is in Canada, for the record. Um, and I mean, it has these Canada leaves right here, so I guess it kind of tells you that. But the point is like I was like, huh, maybe I should look closer at this. I was like, I don't know, is there like some way I can think about this? I've been looking into this company, and like honestly, I'm not a huge speculative position type person. I it's something either cash flows or it doesn't. For me, this is something I think is potentially really interesting opportunity. I'm going to be looking, trying to do a lot of research on it. That's the thing. It's like I think it does cash flow. I think it just depends on how you define the cash flow. But this company, apparently what they do is that their whole focus is on building resources and reserves. Like they are not a production company. They're not attempting to become a production mine. That's not what they do. All they're doing is trying to through resource, discover, acquire larger amounts of resources and reserves. So that's what they're doing, is basically just trying to acquire these projects, get the permits for them, get all the paperwork in order, and then build a joint venture with a production miner to essentially start extracting those resources, which is kind of just a different business model, a different approach. Is like rather than doing the mining themselves, they're essentially trying to organize the project from the ground stage level. And they're reasonably far along on that KSM project, is what it sounds like. They're still relatively early stage, but the point is like they're at the point where they're really trying to shop around to get somebody to want to do that project with them. And I don't know, I started running some of the numbers on it. It's pretty insane, some of the numbers on it. Was like, I mean, like, so this is their presentation. They've had some previous studies done on the here's their resources, by the way. This is like how they, this is kind of like how they paint their business models. Like here they have the proven and probable gold reserves. So this is like the reserves is the gold bars. This is like when it's like believed that it's understood the profitability for the mine. Like that's what that means. Is like reserves means you understand the profitability to a reasonable degree. Then measured indicated means that we know there's gold there, but we're not really sure how profitable it is, but it's pretty much sure that it's there. Then inferred, which is the level above that, which I didn't even mention before that level because it's kind of like the next most foggiest of levels. But basically that's like the level where it's saying like, we don't even really know how much gold is there, but we think there's probably some gold there because gold is usually in places like that because of this, and this, right? So it's like, this is like, we understand the economics of it. This is like, we understand the geology of it. And this is like, we don't really understand it at all, but we think it's there. That's kind of like the kind of three different stages of it. Then here they have their shares outstanding. So like here they show like, yeah, they've diluted a lot over time. In fact, there was a starting on this stage here. So they've more than doubled their share count in a 20-year period. Looks like it's like almost 150% over a 20-year period. Oh, well, it says right here, share count increased 233%. Right there in front of me. Whereas they've increased their total gold resources by 1,000%. Though, like I said, that's the resources, which in my opinion, like I said, you don't necessarily want to include that full amount. You're more concerned with this amount. Like this gold amount is really the amount that, this is the amount that is your bang for your buck. The blue amount is like is your call option amount. And then the silver amount is kind of a fuzzy, vague, maybe possibly some point 100 years in the future kind of thing. Like I wouldn't even think about the gray amount. The blue amount is important because, like I said, that's kind of like your call option, whereas the gold amount is your actual production. But anyways, the point is like just looking at like resources per common share. They compare themselves to like other companies because you might say it's like, okay, well, production company, how valuable is that? Like how much value are they going to actually be able to get out of this if they're so far removed from the stage of production? Because like I said, this is more like a speculative play potential, I think, that potentially exists here. So like huge amounts of reserves compared to like what is typically held by a typical company. New Gold, there's that one that I'm a fan of. Barrick, I've held them in the past. They're a pretty major player. I've looked at the valuations of various of these other ones over time. Their actual share price, so like they've done tremendously well as a stock. That actually is true. That growth in resources has turned into returns for them. So like they've gone up 1,000% in total gold resources. They've not been producing gold. Like they've had this kind of share performance since then. Now, obviously, the big elephant in the room is that they have not gone up in share price since about 2011 or so. Like that's basically when they peaked, which coincides with the peak of the previous gold mania cycle that we saw back then. So then we had this rebasing level in the price of gold, and we've had this explosion higher since then, but they themselves have not gone up since then. Which, by the way, technically that's pretty true of a lot of gold miners. Like that's like kind of the story of a lot of gold miners, is that they had like a peak back during this mania period. They've rebased in the same period here, but then since the explosion here, nothing has happened. If we come to literally the gold mining index, GDX, I thought this index went back further than 2007. I was kind of hoping to see some of this period here, but you can still see it. It's still technically there. I thought it went back further than this, but yeah, the peak level back in 2011, coming down here, and then we had a little bit of a takeoff in 2020, but then not really. Then it kind of came back down pretty significantly since 2020, and then since that, then we haven't even retaken off since then. Because like again, let's compare that with gold. Just like compare it since 2011, right? Since 2020, right? Yeah, so it's like gold miners are just underperforming gold to a massive degree. Now, it's worth noting that like people often make those comparisons. So, like for example, like people in the gold mining space will often compare the ratio of gold to GDX, and they'll be like, "Oh, the ratio of gold to GDX is so and so." And I don't necessarily think that there should be a consistent ratio or anything like that, because an ETF moves players in and out, and then there's also dividends that are paid out of the company. So it's like it's not really an apples to apples comparison to make an ETF comparison to a commodity price exactly. But over a short period of time, there's going to be some viability in seeing the difference in the performance between those things. It's just that there shouldn't be really a consistent trend over time. But anyway, so the point I'm just trying to make, then coming back to like Seabridge, is that like yes, they have not come back up to those peak levels since 2011, but that's not necessarily like a them thing. That's kind of like a gold miner thing. Now they are on the speculative end of gold, so that's probably one of the reasons why they are in that camp. Much like many of those other players, is because like they really are a super high beta play that's only going to be super valuable as gold prices continue to explode higher. Because like I was kind of saying before about the nature of how one thinks about gold, the gold valuation, and like the all in sustaining costs, that kind of requires an understanding of that economic feasibility. So the fact that they have such like a low level understanding of the economic feasibility at this stage, they only really understand it for so much of the resources, means that they don't really understand the profitability of all of the resources. They just understand a decent level of profitability for some of the resources, and that's kind of where it gets a little bit fuzzy. Oh yeah, see here they even have a slide in their presentation: ratio of GDX to gold over time. See, it's at an all-time low level. It's like, yeah, but I mean, if we added back all the dividends that GDX paid over this time frame, that might make a big dent. And then also, if we took into account the different components, the component changes, the companies that moved in and out of the index, that might make a big dent to UTU. I'm not sure, because I'm not sure how to account for that one necessarily. With dividends, you can add it back, but with component changes, I don't know. There's not really a good argument for that necessarily. But the point is like that. Yeah, this ratio has been coming down, but it's not like it should be at some sort of static, consistent ratio over time or something. There's just maybe some argument to say that like over a 1 year period, you would expect GDX and gold to have a similar return ratio or something. But then over time, there's going to be a decay, so there's going to be a static ratio to it. But anyway, coming to the KSM project, because here they have some details about the project, some of those initial studies of like feasibility, and you're going to get to like some of the my perspective on like why I think there's actually some potentially insane value to this company. It is super speculative, but the point is there may be actually something there. Let's see what Jack said. What yield can you get on gold though? Because that would have to be added to the gold return as well. What do you mean? Gold doesn't have a yield. Gold's a zero yield. In fact, that's like that's honestly the way I think that's another good way to think about gold conceptually, is like a perpetual bond, zero coupon. And there's no way to get yield. Well, there's ways to get yield, but then that's not gold that you're technically investing in. You'll be technically investing in some other vehicle that's going to have some sort of, there's going to be some differences to the risk profile if you do that. But there are ways to get yield on your gold. Like there are people that, like, if you park your gold with them, they'll pay you a yield. And I've seen various versions of it. Like there's some that'll pay you a dollar cash yield. There's some that will pay you a gold yield. Like they'll literally pay interest in some like fraction of ounces or something. There's ways to get yield on gold. But they're artificial. They're not. That's not the true yield of gold. Like you're just kind of creating a construct of it, right? That's not like the literal yield of gold. That's like looking at a covered call ETF and saying, oh well, that's the yield of the S&P 500 because I made a a covered call ETF out of the S&P 500, right? It's like you can increase the yield on the S&P 500, but that's not really the yield of it. But yeah, there technically are ways to do it. I'm not really interested in that. I'm actually totally fine with the idea of gold being basically a zero coupon. I think that's sort of like a good way to conceptually think of it. It's a zero coupon perpetual bond that's inflation adjusting. So it's like a zero coupon perpetual tips is it's kind of like what gold is. And if you look at gold does correlate well with tips. Like that's actually a reasonably solid way to think about it. Tips. What the tips yield? Oh well, I can't. Sorry. Oh wait. Wait to. Oh wait, that's the ETF, not the yield. It's I don't really want to do it right now. It's a lot of for the show. You can make a chart for yourself, or I can make a better one for you later. But yeah, no, it's like if you look at it on a chart, gold's the year over year changes in gold and and tips rates are like pretty neatly correlated with each other. Then there's plenty of other factors that will go into there, like supply and demand dynamics and stuff. But like gold's like number one best competitor, so to speak, is essentially like a tips rate. That's like the most one of the most comparable things to it. So it's like yeah, you can technically create like a yield for gold, but it just doesn't technically have one. That's just not what it is. It's a thing that doesn't have a yield. Its yield is it inflation adjusts. It's like gold inflation adjusts. That's what it does. Um, so, but anyway, begin to the thing I was kind of wanted to say. Like a basic calculator. Here, here's kind of like the basic economics that they had for their initial feasibility study back in 2022. They put a bunch of inputs into like the assumptions here. So that's one thing to understood. Like for their case study on the recent spot case, they assumed a gold price of 2,600, copper price of $4, and a silver price of $30. That's like an update versus like the 2022 case they used where they did like 1,700, 350, 1,800. So you can kind of like look at the differences between the two. So like it's even just starting with like this 2022 case where they had these prices. Then here, this is like the actual reserves that they're assuming, like this many tons. They're assuming this many tons turns into this many ounces, pounds, and ounces of gold, copper, and silver. And then they're assuming a certain amount of like mineable dynamics of like this much ore per ton and like this much cost per this. Then that assuming a certain amount of years, 33 years of mine life, which is a pretty hefty amount of years. And then assuming an annual production for years 1 through 7, because they don't really want to make assumptions beyond that point, of 1.4 million ounces of gold, 250 million pounds of copper, 3.8 million ounces of silver, and then the life of mine production. So it's like for the first few years, they're assuming this much for the first 7 years, and then for the remaining years, or not for the remaining years, for the total life of the mine, for the total 33 years, it would be this much. So essentially, to figure out for years 8 through 33, you essentially have to like take this average, subtract out the amount that this included, and find out what the average was for those back-ended years. Kind of a weird way that they show it, but that's what here. And then here was showed what I was kind of talking about with the capital cost. They have like the initial capital cost is 6.4 billion. So they're saying that it would take $6.4 billion to essentially start up this project. So that's like, by the way, one of the reasons why you might be like, oh, well, if there's just this gigantic deposit out there and this company has like the permits for it and stuff, like why aren't they just hopping on it, right? Like why haven't they just started it up already? And it's like, well, this is one of the tricky parts to it, is because essentially they need to find a company that's willing to be part of this project, that has like both the desire to be a part of the project and also like the skills and experience to be part of the project. But then they also have to find like capital investors to supply that capital too. So it's like it's a little bit of a tricky thing, but $6.4 billion to essentially start up this project. And then it would require $3.2 billion in sustaining capital over those like 7 years to essentially like keep it maintenance going, to keep it going. total life of mine capital costs of 9.2 or 9.6 billion. So pretty significant amount of capital. That's just capital expenditure to get it going. That's not operating costs. That's just the capital expenditure. So $9.6 billion in capital expenditures over the course of, I believe it's essentially saying that you pay that over the 7 years. And then there's the unit operating cost. So then they're expecting $11.36 USD per ton to mill. So it's going to cost that much, $11 per ton to mill. Again, we were saying that the tons in total is almost 2.3 billion tons. So 2.3 billion times $11.36 would be like the total life of mine operating costs in order just to mill out all of that. And then we would have on top of that cash operating costs in order to net out the byproducts to get to the gold, which would be $275 per ounce, which, by the way, this is an extraordinarily low cost mine. This is like, if over to like I can pull up in one of the cost curve, pull up like the current cost curve. Like this would basically be one of the cheapest mines that would exist. So it would be in terms of like the actual operating costs on it. So it's an extraordinarily expensive mine to get going because of how huge it is. But like once this thing would get going, the all-in sustaining costs net of byproducts, which net of byproducts is kind of like a big caveat there technically, because the more byproducts you have, the cheaper your cost ends up being. So it's like ends up being $601 per ounce of gold. Pretty outstanding. And again, that was back in 2022 when we got that estimate. Technically, they found a lower estimate in the recent years when they did that. So it's like even if we just assumed the higher estimate was more accurate, that would be pretty outstanding. Of course, like I said, there's still $9.6 billion in capex that you would have to put into that too. And so it's like if we took the 9.6 billion and divided it out, it's like that might eat into that a little bit too, a little bit. And then obviously the time value of money aspect eats into it pretty significantly as well. But like they do their own estimates on it. They make their own net present value on this. So that they don't do like they're not looking at it from like an upside. They're doing literally a net present value of saying like how much market value is this add. But their net present value that they find the project to be worth is about $8 billion. So like they're saying that like even if you after paying $9.6 billion, the present value of the cash flows today, and I don't really know what discount rate they used on the project, but I've seen a lot of these types of estimates. They can be like anywhere from like 5% to 12%. So I'm gonna assume maybe it was like maybe like an 8% or something. But so if we assume maybe like a 7 to 8% discount rate or something, and they got a net present value of $8 billion, which is pretty impressive. After tax internal rate of return they're seeing is 16.1%. 16.1% for 33 years. Keep that in mind. So that's pretty impressive. Payback period 3.7 years. After tax cash flow of almost 24 billion. That's the total amount, 24 billion over 33 years. So yeah, what does that end up being? That's 0.7 or something. Yeah. So that means after tax cash flow, they're saying on average, it's going to be, that's a very, very wide on average. It should be noted. So I'm saying on average, it's like 727 million per year, but it's going to be super lumpy. It's going to be super lumpy. Like for the first few years, it's probably like negative a few billion. And then like in the back half, it's probably positive a couple billion or something. But like for 33 years, an average of $700 million in after-tax cash flow. So yeah, that's the dynamics of it. Like I said, like I haven't made like a proper DCF on this. I was just kind of like thinking through the numbers on this, and it's like the napkin math seems insanely good. But like I said, it's like it comes down to a lot of questions though, because like you have to think about like when do the cash flows get delivered. So it's like even if you think about it, it's like if you're thinking about it as though they start paying those costs today, then yes, it's all insanely good. But if you think about it more in like they start paying those costs 5 years from now, and then you have to take it that 5 years from now back to the present value today, which then cuts into the cost further. I don't know. Like I said, I still did some various math on it. I still even like made assumptions where where you assume it takes like 10 years for them to even get going. And I still basically I found it like super impossible for this not to be like a positive value opportunity. It's just a question of how positive value opportunity do you see it as? Is this like a 15% cogger type investment? Is this a 20% cogger type investment? Is this a 25% cogger type investment? Like I said, it's like it's a speculative play, so that it's potentially really, really high returns. It just kind of comes down to some big assumptions about what you think happens in terms of what deal they make with what player, what type of cut they have to give that player, what type of like I said, how long it takes for things to get going, how many roadblocks they'll run into, whether like the Canadian government decides to throw some big fines at them. There was like I was reading their annual report, and like apparently last year there was some company came out of the woodwork to try to claim that they actually didn't have like the proper permit rights to the project or something like that. And it looks like that was overturned in their favor. But the point is, who knows? Like some other company comes out of the woodwork to try to do the same thing. Because again, it's like it's a big multi-billion-dollar project. So it's like, you know, there's a lot of people that might want to fight to get their piece of that if they could, right? So yeah, I don't know. One of those things where it's like I'm looking at some of the math on it, and it looks almost too good to be true in some regards, which makes me believe that I might be missing something, right? Like, you know, maybe there's some big huge caveat that I'm missing beyond the fact that yes, this is a company that does not cash flow. It currently, like I said, it's like we're assuming all the cash flows show up in the future. That's basically what's going on here. But point is, those cash flows do seem extraordinarily huge in the future. So that's why it's like, to me, it's like I yes, it's a cash burner and a diluter in the short term, but it also seems to me like we might be at the end of that dilution train. Like, I don't know. I'm like I said, I'm looking into it. I just thought I'd bring it up. I'd bring up a little bit of it here today because, like I said, that was one of the most interesting of the gold mining companies I've been looking at. It's just one of the ones that I have nothing. I don't have it like I don't have a super tangible value to share with you about it because it's so speculative, unfortunately. Why is it on that chart twice? Which chart? I was scrolling through a lot of places. Are you talking about this one? You mean this? Um, as if this is what you're talking about, it's because of the categorization. Uh, here it shows in the category of measured and indicated, and here it has uh the inferred. So like this is like I was saying in the had chart here this. So the first one was including this, and then the second one was including this. That's basically what it's doing. Which, because like even here it says M&I, which means measured and inferred. That's technically not accurate because like come over here, this is measured and inferred. This is proven and probable, and it's saying that all of this is measured and inferred when actually like half of it is proven and probable, which is way better, way better. It means is like that means that we sort of believe we understand the profitability of what the project actually would be like, right? That's actually better. That's much better. So like this chart technically outdated to say that this is M&I. This should say P and P. Like down here, you see some of them say P and P. So it's even better. But that's why it's on here twice. I remember like when I first noticed that, I was a little confused at first too. So I was like, wait, what? Why is it on here twice? But it's because it's that big. It's that big of a project that like if you combine the whole thing together, the measured and indicated and inferred all together, it would just be like that freaking huge. It would be twice as large. Because like here you'll see that this BHP project that's huge has M&I and I together, right? So like it included both of them in the one thing. Maybe it's doing that because it's already producing, and maybe they did two separate studies on these sections. But it's just interesting. It's like that's just how huge of a project it is. So, what is the catalyst event that unlocks the value, and can you just invest the moment that news hits? Sure, sure. Um, but then you have to think about the fact that every trader and their cousin's going to be beating you to it, and it's probably going to like this is probably the type of catalyst move where it literally doubles in a day or something. Like I imagine like it really is kind of like that kind of thing. Um, because I mean it's it's not that different from like a biotech that gets its approval, right? Like it's really about that binary of a thing. Because yeah, it's I don't know. Like I said, I'm still sort of looking into the finer details of it. So like, I still need to really make sure I fully understand everything. But because like, what I was reading, because like I was reading through their annual report last night, and like it seems to me like we are not more than like a year or two away from having a solid deal at most. Like I feel like it's this year actually, but like I don't know. But that's the thing is like that's them making the deal, and then it would presumably take a few years for that company to like actually get substantial progress on it going because we're not gonna see cash flow until essentially that 6 billion worth is already gone through. So it's like it's like you're not gonna see like it's not gonna turn into revenue still for probably most of a decade or something, but the assurance that that's happening is going to happen in stages along the way. Like they'll probably make the deal with from my understanding is like they'll probably make the deal with the joint venture maybe this year. I don't know. Maybe it takes longer than a year to find the right deal, but like it feels to me like that shouldn't take that much longer. Maybe it just comes down to just how much fighting they do over the terms. I don't know. Like maybe it's something where they're just going to negotiate to death, and maybe several deals fall through before they find one. Like I said, it's like I've really only started looking at this one. I just wanted to talk about it because it seems to me like potentially a huge opportunity. Because I mean, again, like I mean, I don't want to run through all the kind of spitball valuation estimates, but it's a $1 billion market cap that's sitting on top of billions and billions of dollars of net present value. Um, like I said, it comes down to what estimates you make because like they have this after tax net NPV here of 5.8 billion or 10.8 billion at the higher ore prices, mind you. But this net present value isn't necessarily like turning into free cash flow to equity, right? So it's like it still even if it was like half of this, maybe that turns into free cash flows that actually get delivered to equity or something. That's still like yeah, like that's still like 5 to 6 billion, right? And then maybe they're using too low of a discount rate, so maybe it's 2 to 3 billion. And like I said, that's just running off this present value thing. I did my own kind of napkin math last night and was getting kind of similar numbers. Like I that's why like I'm kind of just running off these numbers this years because I did some estimates last night and I found that these estimates to be not crazy. Like I say, it comes down to certain margin assumptions you estimate and certain discount rate assumptions and certain timing assumptions. But I don't know. Like I feel like it's difficult because I feel like the catalyst comes in stages. It's like you're gonna get the catalyst that they made a deal. You're gonna get the catalyst that the joint venture company has started making significant groundbreaking progress. You're gonna get the catalyst that they've like reached ore. You're gonna get the catalyst that they've started pouring ore. Like there's gonna be different stages of catalysts, and so that's why it's like I'm not sure like it might be tricky to try to wait for. But I don't know. It's like it says, like it's tricky. It's tricky. If I mean, you look at the chart over the last several years, right? I mean, it looks like it's potentially at a reasonable buy right now if we're assuming that like this kind of trend here is somewhat of a basing of some sort. Like if we, not a big charter guy, right? But if we do some chart magic and we sort of assume that there's some sort of like basing going on over here, then this at least at its current levels is maybe a lot better than if it was up here, right? So it's like it maybe isn't a terrible spot to maybe take a speculative opening position or something, and you just be very very delicate on your ads. And like I said, this is like something I'm thinking about as like a maybe speculative play. It's like maybe you do like a 0.25%, a 0.5%, maybe even if you're feeling funky with it, up to 1% of your portfolio or something. Is like this is the type of play. Like if what I'm thinking about it is true, the returns will deliver on a really small percentage. So it's not like you necessarily need to go too crazy with it. But I don't know. I plan to try to actually build some sort of model for this. So that's why like I'm speaking very fuzzy about it because like I've only really done some super napkin math with it, but it seems pretty crazy of an opportunity to me. And I feel like people aren't hopping into it because they have a lot of doubts about when and how that 6 billion shows up, right? Like you don't get the cash, you don't get or 6 billion, 12 billion. You know, you don't get the. I'm looking at the wrong one. That's right. This is the KSM preliminary. This is one of the other projects. My bad. I was looking at the wrong slide because they have other projects other than KSM, mind you, for the record. Like KSM is actually just like one of their larger projects, but technically Seabridge has other stuff going on. But this is what they do. It's like they basically prepare projects for other mines to take over and actually develop. That's kind of like what their whole business model is. And then they get like a revenue stream cut as a result of it. Um, so yeah, I don't know. Like I said, I'm still just trying to think through it. It just seems like a pretty crazy opportunity to me. That I kind of wanted to bring attention to. So yeah, a very kind of fuzzy discussion about miners. I know we were kind of all over the place with it. I wasn't as clean of a discussion as the home building discussion. I kind of had a little more of more of like a narrative planned out about how and why and what I was going to talk about with the home builders. Whereas like miners were kind of just like spitballing my random thoughts about a bunch of different things into it. But the point is like I've just been getting more and more bullish on it. It's like, gold going up has only made me more bullish just because it has, in my opinion, it's essentially like said, it's kind of like shown that I was right about various things over the various years. And also it has to do with the economic dynamics surrounding the gold price. It's not the gold price in isolation. It's really that it's happened at the same time of certain economic things that were supposed to happen when I said like things related to the deficits and interest rates and inflation and stuff like that. So it's like it's all those things together why I'm so bullish on gold. But the fact that miners have been just so significantly underperforming, to me, it seems like all the miners are priced like gold is coming back to here and then it's going to stay there. And like, yeah, maybe it does come back to here, but it's not going to stay there. And I think that that's basically like almost for sure. So it's that's why I'm my confidence in the play has only grown more over time. My aversion to making it a huge portion of my portfolio still exists because it's a commodity industry, and I try to be careful about over allocating my portfolio to commodities. But I do think that the overall fundamental trends for gold are just so strong that it kind of like bypasses, I think, a lot of those usual commodity concerns. Um, Royalty and streaming, I assume you're asking about the revenues for Seabridge. Yeah, basically, yeah, it's like they would like I said, they it all depends on what deal they would make, but basically they would be making some sort of royalty streaming agreement with them based off of the total revenues coming out of KSM. And in fact, because they've already made some similar deals with their financiers, because like I said, like they obviously are diluting their share count, and they actually also have debt as well. So you might be like looking at this and be like, oh, who are the people that are providing the capital to these guys for the last 20 years while they did this, right? Because like I said, it's like they've been doing this for 20 years, 20 years with like basically no revenues, right? Like obviously somebody's supplying the capital, and it's because there are people that know what's going on here. They understand what's happening, right? It's like there are people that are willing to supply the capital, and they are promised revenue streams is what they are. Like I was looking into like because they have secured notes. They have some secured notes that are basically secured by future potential royalty streams rather than significant interest costs. And like, because that's what I was wondering. I was like, how are they financing this? I was like, how is it that they're even alive? Like, how does a company like this even survive? And I was pleasantly surprised at the kind of the clever structuring that they do with that. So I would assume that they basically that structuring would kind of carry forward, that the junior venture that they would make the agreement with would be kind of making their own royalty streaming agreement with them. But they kind of made it clear that like the specific structure would be very unique to the company. Like that's part of what's I think holding them back is all those details. What about basic material miners, London Mining? Just like some of like the basic construction aggregate companies and stuff like that. I mean, I don't have too much of an opinion on them too much. I pay attention a little bit to some of those kind of baser metals because, like for example, like Silvercorp. I don't know how much you looked into Silvercorp, but Silvercorp actually does have a pretty significant amount of base metals lead, like they sell like a decent amount of lead and stuff like that. I'm not 100% sure what type of basic materials London does, but I think they're in that kind of same camp of like the base metals. But I don't have a huge, I'm not as bullish on them because like I said, it's like a lot of my specific bullishness on gold has to do with how people treat it in relation to monetary debasement and central banking and inflation and things like that. And while a lot of those same dynamics are going to affect commodities as a whole because inflation and monetary debasement are involved in there, they're going to affect them all differently because of the supply and demand dynamics. So like I'm bullish on copper because copper has a lot of that like electrification theme playing into it as well, which was one of the other things. Like I said, like I'm as an industry theme I'm focused on is electrification. So copper is kind of interesting to me for that reason. And I'm interested in like you and I were talking about AMR a little bit, and I know I was mentioning like some other people were talking about AMR in the Discord server, and that's partially because like some other people as well as myself are also very interested in the metallurgical coal space in particular. Steel, I'm relatively bullish on steel industry. I still kind of want to do some finer research on that industry as a whole, but I do think that like steel is another interesting metal to potentially be involved in. But some of like the baser metals and other basic materials, I don't necessarily have like a super strong like tailwind reason to be super bullish on them. It's like I said, it's like my bullishness when it comes to commodities usually is very specific to specific things for specific reasons. So I don't know. It kind of would depend. It would kind of depend. I don't have negative thoughts to say necessarily. So might do reasonably well, but I don't necessarily understand the space and the supply and demand dynamics to necessarily have a huge take on it. Yeah, met coal, iron, nickel, copper. Yeah, met coal, copper, nickel. I've seen reason to believe that there's strong reason to be bullish on. Like people talk about nickel, but I haven't actually looked into it as much. So I it's one of those things where it's like I hear people talk about it, but I haven't looked into it enough to really confirm how bullish I would be on nickel. But potentially reasons to believe in there. I'd put aluminum in that same camp. Aluminum is kind of in the same camp. I've kind of wanted to look more into um, palladium as well. I've heard some interesting things about palladium supply and demand that kind of makes me want to look into that more, but I don't know too much about it. I don't know too much about iron. I've heard some reasons to believe that like the supply levels are relatively high in iron compared to demand, and then that also comes into what one thinks about like global levels of demand of certain commodities versus others, and this comes down to like the regional question of like what does one think about the Chinese economy and the Indian economies, and like where the trajectory of each of them are moving over time, because each of them are big players in a lot of the commodity spaces. So it's like because like I'm pretty bullish on met coal because I do think that steel is going to do reasonably well, but I feel like iron and on some of the lower ends of steel might not do as well. But like I said, this is based on some things that some commentary I've heard from the places, but I haven't looked super deep into it. So it's like I'm not 100% sure how true a lot of those things are. But yeah, so it's like you kind of have to pick and choose your commodities on like um which ones you're more bullish on than others. But a lot of the industrial metals, I have there's reasons why I like them. But some more than others certainly. But yeah. So I mean I think that's most of everything I kind of wanted to talk about with the those metals. I think these last few comments though, but and we're coming up on close to 3 hours. This is probably one of the longer streams I've done in a long while. My voice is definitely starting to feel it. Honestly, I like the idea of being agnostic on the commodity and seeing how the companies can remain solvent if their commodity is low. No, I mean definitely that's always like you should always be kind of stress testing your commodities, but I think it's difficult to be neutral on a commodity at the end of the day, I think. Because like I always took that approach too. Like I watched, like Demoteron has lectures on how to think about commodity companies in particular, and took a lot of his ways of approaching it to heart. But at the end of the day, I think you can build your model so that it inherently has a certain kind of agnosticism to it about the commodity price, but eventually once you build the valuation, you still kind of have to have that input in there. So it's like even when you try to be agnostic about the price, I think you're kind of inherently taking a stand on the price in some sense. I think the only way that that's not true is if you're dealing with commodity companies that are like really hard hedgers. So it's like if you're dealing with a commodity company that like really like maximally hedges so that they're like basically collared between a certain range, like no matter what, you know, like those ones you are really taking the commodity price pretty significantly out of the question. But I do think it's actually a lot harder than it sounds to be agnostic on the commodity price. Um, you can certainly just be super conservative though, because like the second half of your comment basically implies just conservatism, right? It's just using a low commodity price. Because like I know, like for example, like I was saying, like with the reserves, right? Like the companies themselves, like if you look at all mining companies, they're all going to be using like the something that's close to like the 10-year average of whatever their commodity is, or maybe a 20-year average even, right? Like it's whatever they're valuing their reserves at is usually a very, very like conservative estimate in a rising commodity price economy, right? In a positive inflation economy, to be using like the 20-year average of your commodity or whatever is a pretty conservative estimate, and that's like literally like what a lot of the commodity companies do. And in their estimates of their projections for the future, they often use very conservative estimates for the revenue estimate as well. Because like and like when they give guidance, a lot of times when they give guidance, they don't even give you a revenue guidance, they just give you a production guidance, because they're just like, you know what, we're a commodity company, we don't know, you know. So it's like the companies themselves tend to be pretty conservative on that front. But the thing is that I will say that makes it really hard to find a really good company in the space. And you might say, well, that's the point. I don't want to be invested in commodities unless it seems really, really good. But then I would say on the flip side, then you have the other problem, which is to say, then you're still going to be giving up a lot of the potential upside, right? It's like if you can if you're really conservative on your valuation, you can still find something that's a good value sometimes, but then you might give up on it before fair value even, right? So it's like it's difficult. It's difficult with commodity companies. It's like I've invested in a lot of commodity companies in my investing time, but a lot of people shun them altogether, and I've kind of always had a little bit of a soft spot for them to a certain extent. But I think I try to recognize a lot of the risks and their problems too. But I think you just kind of have to learn to accept that risk to a certain extent. It's like I find that commodity companies are great for some reasons too, because commodity companies, you don't control the price at all. Like you literally have no control on the price, but you have really, really fine control detail on a lot of the production. And the companies themselves give you a lot of that detail too. Like the fact that I'm even able to do that mine level uh uh modeling for all these companies is great, and that's because they give me all that detail. And partially they give me all that detail because it's so neatly uniformed, because mining is just like that. And many commodity companies are like that. Like that's just true of a lot of commodity companies, where they're going to be like, at this location we have this many bushels of this, and at this location we have this many ounces of this, and yeah, this many location we have this many equivalent barrels of this, right? And it's just, you can get really, really nitty gritty on commodity companies, whereas like some companies don't give you very much information to do much modeling with. Commodity companies give you more information than you generally could ever have even wanted. Um, I certainly am not even I'm not even using like half of the information that they give, um, because they just give so much of it. So it's one of those things where it's like you get no certainty on the price, but you can get a pretty high level of understanding and certainty on a lot of the other details. And so, I don't mind commodity companies, because I like the fact that I can do this kind of modeling to this fine detail if I so choose. Um, so yeah, I don't know. As I showed even with those models, because like you can look at the prices I use here. The like I said, the bear base and bull prices that I had here. I'll tell you how I got them. So like over here on the gold prices that I list by year over here, I list the average daily price for that year. So this is what the average of all the daily prices was for each of those years. And so in 2024, the average price was about 2,400. And I assumed that my bear case price in 2034 was the average daily price from 10 years prior, right? So that's like a 10-year average, but it's not even a 10-year average. It's a price from 10 years ago. And then my base case, I essentially just used a 2% cogger from there, and then a 4% cogger from there for my bull case, my bull price. That's how I came up with those prices. So like all of those prices, like I'm using a 0%, a 2%, and a 4% growth off of it, but I'm basing it off of the year average. So you could say, oh well, maybe that price was high, right? Like maybe in 2025 prices dropped down below $2,000 an ounce, and then suddenly 2,400 an ounce seems really high. Like as we showed here, gold for like 10 years, the idea of $2,000 an ounce was like a pie in the sky kind of idea. It was like, oh, gold didn't, we'll never get back to $2,000 an ounce. When are we going to get back to $2,000 an ounce? We reached it. It was like we got almost to $2,000 an ounce in 2011, and then it took almost 10 years to get back up to actually hitting 2,000 an ounce. And then once I remember when it hit 2,000 in 2020, huge question in a lot of people's minds was, oh, is this the peak? Is it going to come down and it's just not going to hit it again for a long time? Well, it only took 2 years for it to go back to 2,000 again, and then it kind of stayed in that range for a few years, and then now we've broken up above that again too. And that's kind of like what gold tends to do a lot of, is this kind of like basing, settling, and then pushing back up kind of effect. And you see it like every handful of decades. The distance between those move ups change. And this tends to happen with large debasing events. So basically, the government does a large debasing event, and then the gold price moves up. So that's why it's like, in my opinion, using 2,400, which is the average of last year's price, which is kind of midway up through the most recent kind of leg up. I mean, 10 years from now, I feel like it's a pretty reasonable assumption to have. And that's just like how I approached coming up with that price. Like, you could have used a lot of different ways to think about, oh well, what's my price target's going to be. You could have used a much neater, fine-tuned approach for that. But you could also just say 5,000, 3,000, 1,000. You could just make up some numbers too. So anybody's estimate is really as good as the others, but a 10-year average, it's not 10 years, it's like 8 years, but would be like 1,700. So 1,700, like I said, 1,700 is I think that's pretty close to like what a lot of companies actually value their resources at currently. Arian, long time no see. Yeah, I've definitely been pretty slow on my stream output lately, though we had a very long stream today. You're catching me right here at the end, though. I will say, basically was kind of just into some closing thoughts. But yeah, so that's all my thoughts on miners from now. Like I said, I'm still looking at several others, still looking at home builders. Like I said, I'm hoping to do the Lennar video at some point here in the near future, maybe in the next week or two. And then beyond that, I'm hoping to, like I said, update my models on my portfolio holdings as the 10Ks come out. In particular, I'm really looking to get deep on my annuity model and pension risk model, and hopefully look to see how much more upside I see on that, because I do think FG is a reasonable bargain right now, but it comes down to what you think about some of the details there too. Oh yeah, Jack, I see you commenting on B2G. B2G. I will take a look on that one. I can't remember if I had that one when I was looking at my asset quality lists. I'll take a quick look on that one at some point this week, maybe, and try to get back to you on that. I'll see if, because I can't remember what they have, so I'm trying to remember how easy it would be to kind of throw a quick valuation for them together. But I'll take a quick look at them at some point today, and then see what I might do, and maybe I'll do something this week with them. Get back to you on that. Arion InMode. I commented on InMode a little bit earlier. We didn't really get into details related to them, but I was just saying, like, still holding them, still kind of in waiting pattern for them. We'll have to see what happens with them. I'm happy to see that the share count is really starting to come down. They approved another buyback program, so that's going to continue to happen. Hopefully they'll continue to execute on the buyback program. They authorize another 10% for the next 6 months. Presumably they're going to go through that another 10%, and then hopefully they'll authorize another 10% for the back half of 6 months. And then hopefully they will start to get some growth back in their equipment sales this year too. That would also be nice too, to actually see a return to growth in the fundamentals. But my current valuation basically assumes that they don't really do much this year in terms of fundamentals, and that we really don't see a return to growth until really like next year and the year after that. And even then, this estimate here assumes very modest growth going forward. So I will say that for the most part, it's like I do think that we just kind of have to wait and see the buyback program start to pan out, because I do think that as they continue to buy back more shares, a lot of they're going to start to show up on other people's screeners, and probably a lot of people will start to like buy into them specifically for the total shareholder yield that has been happening. Plenty of people filter and screen based off of that too. So and then also there's also quote unquote peace in the Middle East that as a potential catalyst to keep an eye out for too. It's like they definitely got further multiple suppression because of all the conflict. So if that stuff starts to alleviate over time, potentially that will hopefully maybe start to lead to some expansion in the multiple on that front as well. So in mode, we're kind of just in a holding pattern. I've at various points wondered if I wanted to add to them, but I've refigured my allocation system a bunch, and I just don't want to allocate more to them. So it's one of those things where it's like I do think that they're perfectly reasonably good bargain to be adding to at the current price. When they had dipped into 17s or various low points recently, I've been like, ooh, I kind of wish I would add to that, but it's just one of those things where I do try to keep to my targeting system, and unfortunately I'm just kind of already allocated to them. So that's a woe is me for unfortunately having hopped into them so early back then, but still in holding. Happy to see that the capital is starting to be returned to shareholders. But yeah, so that's my thoughts on InMode. So anyway, that's gonna do it for today. Hopefully we'll stream again in another week or two. I'm kind of been keeping to like an every other week kind of thing for that, and that might be what we do going forward. But yeah, every other maybe 2 weeks till I stream again, but maybe I'll also be able to get a Lennar video out in that same time frame, so that it'll sort of be 2 pieces of content at the same time. I'm gonna be, like I said, doing updating my model for annuities and pension transfers, and then also trying to update my model on the generators for Generac. And then beyond that, we're just gonna probably be continuing to go deep on gold miners, and maybe looking at a few other commodity companies as well, a few other metal companies as well. I don't know, but yeah. So that's what I'll be doing for the next couple of weeks. I appreciate you guys that did come to see me and chat with me here today. The few of you did. Hope you guys have a good rest of your week.